What you're about to hear in episode 23 is a conversation that Zach and I had. We managed to stay away from crypto for a full, 45 minutes to an hour, just kind of talking about the state of the market, investing. Zach actually rehashed his beef with Keith Rabois from early part of the pandemic. We talked through what it's like for him to be a Web 2 celebrity and all the groupies that chase him around. And then on the second part of the episode, what you're going to hear is a conversation I had with Ben and David from Acquired. Folks that don't know Acquired, I can't imagine there's too many of them that listen to this podcast, but it's a fascinating deep dive into a bunch of different businesses, kind of telling the definitive story of companies and how they came to be. And they're really interesting, thoughtful guys that I have a ton of respect for. And they've been really gracious with their time as I've kind of figured out what it is that we're doing here. And so it was an interesting conversation that we go into the history of Acquired. We go into, the state of podcasts in general. We talk about the state of venture capital as an industry and all that. So trust you'll enjoy both of these conversations. Welcome to the 23rd episode of Cartoon Avatars. I'm your host, Logan Bartlett, and I am joined today by recurring guest, Zach Weinberg. Zach, how are we doing?
I am good. I was curious what you were going to introduce me as, but I guess recurring guest is the right one.
Yeah, I don't know. Regular host, person that won't actually take any branding or anything. It's funny to hear like All In almost fell apart over like branding and ownership and all that. And I'm like, hey, do you want your face on anything or your name on anything? And you're like, no, I don't. That's not for me. I don't want that.
Yeah, it's a cartoon avatar that doesn't even want to be an avatar.
That's right. Yeah, they're playing. They're like their egos are getting in the way of like their podcast. Meanwhile, I'm like begging you to try to take any branding or ownership, and you're like, nah, I don't think that's a good idea.
I just don't understand. Like, aren't they all supposed to have a ton of money? And like, you're fighting over some media brand that doesn't matter.
Doesn't everything end up being a dick measuring contest at some level at some point? I feel like, I don't know. It feels like it's all ego and just like ownership and effort. And it feels like it's just like a pride type thing at the end of the day.
Yeah, well, maybe one day we'll hear what actually happened. But when I heard it was over money or ownership or something, it was kind of, that was surprising to me.
Yeah, like God bless him. So yeah. So you've been over the last couple of weeks, you've turned into something of a celebrity, I think. Like, are you? What's the state of play right now? Like, is your wife worried about Web 2 groupies coming up to you and like whatever throwing themselves at you? What's it been like now?
Yeah, I'm not allowed to go to any of the NFT events that's like a safety hazard risk. I would think there's like some equivalent. I don't know what the boomer version of NFT NYC is, but there's some like Web 2 version in which all the women would probably flock to you. Yeah, that's maybe like my dream as a 14-year-old is playing out in a weird way.
You got the nightclub. Now you have, this is the other side of it.
This was definitely never part of the dream, to be very clear. No, well, actually, the really funny part is that I did this recode little thing for 10 minutes just to explain it.
Yeah, I listened to it.
The stuff I do day to day, which takes up 97%, whatever, of my actual job, nobody has any idea about any of this because this is like not what they work on every day, like healthcare and biotech. Nobody gives a shit. So, and rightfully so, to be very clear, like they have more important things. So I don't know. It's been fun. I enjoy it. I don't really like I don't love people knowing me, I guess, in a weird way, but I recognize that that's maybe part of what's required if you actually want to like have a public conversation about this stuff. So hazard of the job. Hence my continued refusal to be like a formal member of this podcast.
It's interesting. I had one of our LPs the other day. I'm coming off a red eye. Again, this is my preamble in case I'm particularly slow versus just my normal horsepower that is slow as is. But I was out in California yesterday with one of our LPs, and they said that the crypto debates had become like regular listening for them as they're thinking through crypto managers. They're all like going through and listening to you debate different people and whether or not these use cases are actually commensurate with the fund size. So it is interesting. I mean, there's been enough jokes on the internet of you or me crashing crypto's prices, but it's interesting to hear there actually is some flow through in some of these things that people are listening to it. So I mean, you know, these are LPs that could be investing in you for other reasons, right? It's not necessarily a bad thing.
Yeah, I mean, if maybe this is like revisionist history, but that part I think is really good for the world in a way, where you have like legitimate questions about investing other people's money into things. And it's not that I care so much about any one LP per se, but, you know, the people behind it, right? Like the actual dollars are coming from, in many cases, it's not just like large academic endowments, it's pension funds, it's retirement accounts, things like that. So I think it's good to ask questions. From my personal perspective, I would actually argue that given, you know, we work in biotech and I'm raising a fund in biotech and all of this probably doesn't help me in any way, shape, or form. It might actually hurt because people think it's like I'm distracted, even though I think I mentioned like I do this for 60 to 90 minutes a day. It's not like a lot of time. It's fun, but it's not a lot of time.
I'm aware how much time. Yeah. For anyone listening, I'm aware how much time Zach spends dedicated to this. And it involves, I think, 30 seconds before we hopped on. I said, hey, had you looked at the doc that we're going to talk about? And he said, no, can you send it to me? And so that's the extent of prep. I think you see the entirety of Zach's efforts in this right now. So yeah, I can validate that.
Yeah. Anyway.
Yeah. Well, honestly, I've been trying to get away from like us talking about crypto as you know, trying to find the balance of like, I mean, it's obviously interesting. And I think in some ways it's impactful, right, to what we were just talking about. But at the same time, we can't hijack the entirety of everything we talk about to just being crypto. That said, you can't really get away from the contagion that is like the crypto markets right now, right? Like I was going through the list of interesting stuff that's happened basically in the last week or 2 weeks or whatever, since we've actually done a real kind of normal topical episode. And like, it's all crypto. That's this, you know, it's like, oh, do we want to spend time talking about Zendex getting taken private for less than, you know, they could have gotten whatever 6 months ago? Like, I don't know. I think that's kind of boring, right? Or like
the tech market's kind of frozen. I mean, you would probably know this better than me, but like a lot of stuff is just not happening because everybody's waiting, I assume. I mean, I'd be curious to hear what you see in the portfolio.
So I think basically what I'm seeing right now in the private markets, it's weird, right? So at the early stage where I don't spend my time, but we do have a fund that does that. I think we've seen valuations kind of correct, I don't know, 20% or something, which I was actually a little surprised by that it flowed through to that part of the ecosystem as fast as it did. But I think at the end of the day, like the ultimate success of those investments, you're not going to be right or wrong based on whether you got in at 35 or 40 or 60. Like as an asset class, that matters for sure. But like any individual investment, if you're swinging hard enough at the pitch, it's either going to work or it's not, right? It's going to be a couple $2 billion business and it's going to return the fund, or there's probably some of those scenarios that it gets caught in the middle. But like for the most part, I think if it turns into a Snowflake or a Stripe or Twilio or whatever, you're going to be fine. And so I think our early stage group is being pragmatic about things, but still like, you know, very much open for business. At the growth stage where I play kind of the series Bs and Cs, it's a super funky market right now. We're actively chasing stuff around, but there's kind of like 4-ish things that I was thinking about that have happened, and it's just led to a weird dynamic. One is that a lot of crossover funds are just like sitting on the sidelines, right? And so like some of these groups that have very big public exposure, they're saying, hey, from a risk-adjusted return, it's actually better for us to focus just on publics, or we're going to lick our wounds and do nothing at all right now. And so like those people, a lot of them are on the sidelines. Then there's other groups like Tiger or whoever that are saying, hey, instead of taking a $200 million round and doing it at $2 billion, we're going to break it into 5 separate $40 million checks and invest, you know, earlier, right, at Series A or Series B or whatever it is. And so that's kind of going on. And at the end of the day, if they're not the most price sensitive, right? They don't really care about 200 or 250 or 300, right? For the most part, they have a much more broad-based underwriting framework that they're indexing. They're indexing, right?
Yeah.
Then the third thing is a lot of the tier 1 companies have raised more than enough capital last year, right? And so they're like, hey, why go out to market and go raise right now? It's super funky. And so why would I go raise? And then the last thing is like a lot of founders are weighed down either by high last round posts from last year or to some extent some expectations of what, hey, you know, I talked to X firm in January and they told me I was worth $1 billion. And they come out and talk to a bunch of VCs and a bunch of VCs say, actually, you're worth 200. If you're a founder, especially at the growth stage, I might go out and raise just right now because you might get someone that will pay a price that, you know, is not consistent with what other people in the market might pay.
I see it from a different end because we, as an investor, through like our little family office group, we do mostly early stage stuff.
Seed-ish mostly?
Yeah, it's mostly seed. We'll do early A's. I kind of think of it as like typically sub $100 million valuations, generally speaking. You know, there's no exact.
One of my companies I was out to dinner with the other day, and they said they, Acuity MD, I joined the board, led the, I guess it's effectively a Series A, really a Series B. But I was like, oh, you should talk to Zach. You know, you guys are selling into med devices. There's probably some stuff he learned from Flatiron. Jacob's involved, obviously, who he used to work with. And then they just hired Ross as well, went over there. And so another Flatiron guy. And the CEO said, he goes, yeah, I talked to Zach. It was in our seed, and he said 9 post was way, way too high. And so it just didn't make sense for him, and he walked away. So
I hate that example because there's a lot of cases where I have made the right call. And that is one where I knew like a few months after it, I was like, I think I fucked that one up.
Yeah.
Because he just like, him in particular, he was really, really knowledgeable about the intricacies of like the med device sales process. Like he just knew the details really well.
Yeah.
And I got caught up on valuation in a way that I probably shouldn't have. And that
you guys have actually been pretty disciplined about like, to your credit. Yes, I'm using an example to rub in your face of like, hey, now it's at whatever. What would that be? It's at 30 times what that was right now or something like that. But
God damn it.
You guys in particular, like as a basket, I mean, you've been pretty disciplined about like where you get involved and you stretched, like ramp you stretched, right? And like even got jammed a little bit on the amount. But like, I think that's probably served you well at this point.
Yeah, I mean, we stretch every so often when the founders are remarkable or the market is massive. Ramp, I mean, we stretch a bit, but it was still sub 100. I would say, yeah, we've been relatively price disciplined for 2 reasons as investors. One is that, you know, we lived through the first crash, right? Like I know people think I'm like 14, but we actually started our first company in 2007 right into the crash. And so I've been through one of these like repricing issues before and kind of understand at least the basics of like, at some point you need to make money.
Yeah.
And we're seeing these valuations on companies where, you know, it was outrageous. So we tried our best to be reasonable. And then at one point, and I'll always give credit to Josh Koppelman for teaching me like 80% of everything I know, whether he knows that or not. But I remember...
Was first round an investor in Flatiron?
Yeah. First round was an investor in Flatiron. First one was our first check at Invite Media. You know, Josh wrote me and Nat a check when we were 20. And he's been a mentor and all this, and he's just like, he's the best. And I hope he listens to that and hear me say it out loud, because I've told him that too, but he really is the best. And at some point, you know, I asked him like how they thought about valuation. And he said, look, I don't have a great answer for you, but at the end of the day, like if I buy into a business at 10 million posts and I buy into a business at $30 million post and it's the same company, you know, that's the difference between 2X and 6X. It's just math.
Yeah.
And I think that for whatever reason, among the many conversations, that one really stuck with me of like entry point price can matter if you're, you know, if you're indexing. And that's what we are, right? Like Operator as a group, we don't make concentrated bets. We tend to do smaller checks in lots of companies. And so
how many investments a year will you guys make out of Operator?
Probably about 40 or 50 or so.
That's what I told, by the way, that's what I told an LP was asking about our like where we are in the market right now. And I said, I mean, we want to be doing deals for sure. I think we can tell the difference between an A company and an A+ company. At least I hope we can. But I know we can tell the difference between 600 posts and 200 posts. Like I feel very confident in that. And if waiting a little bit longer, the math has to eventually flow through, right? The public markets are, you know, if you're growing at over 30% right now, you're trading as a software business at like 6.5 times, right? And like, you can't keep doing deals at 100 times ARR, right? If 6.5 times is the end state of what you're going to be trading at, right? It just like doesn't totally hold.
One other nuance I learned as a individual investor, which is that like when you're investing your own money relative to investing out of a fund, you kind of have a different psyche, because for me, and by the way, I we have a team that does this full time, and I'm somewhat passive in it. I mean, obviously I meet the founders, but I don't do the day to day. And for me, it's like, if I'm going to write a check here, what I'm really boxing out from a capital standpoint is like treasuries or some, other asset class that I'm pulling cash from to invest. And so we just have a different mindset on like, we don't have to return the fund. That's not what we're aiming for. We don't need the like concentrate, because it's not really a fund in the sense that it's just like our own money being deployed deal by deal. So it changes some of the dynamics, but
yeah, I mean that $100,000 could go to like a bet to get an Andreessen partner to come on the podcast and debate you. There are like real trade-offs in all of this stuff.
Yeah, I mean, $100K can be used for a lot of important things. Clearly not important enough, but yeah. What I was going to say is, so I end up seeing this from a different angle, which is like the founders call me, right? Because I get the call from the founders saying, what should I do? I actually had a call this morning with a founder to just like reason through this stuff. And the reality is, like, if you have the ability to extend your runway right now and you don't have to raise, that's probably what you should do, because like illiquidity in a market where actually fundraising is an auction. This is the difference between financing in a private company and financing in a public company, right? Which is like in a private company, when you do a round, it's really just an auction. Right? It happens one time, you seek the highest bid. And if like half of your bidders are just sitting on the sidelines, you're going to run a less efficient auction than you would if they were participating. And when you're doing this in a world where like half the people are sitting on the sideline, you're going to end up probably at a lower price. So you might as well just like wait until everybody's back in the game. And if you can extend your runway by cutting burn or shrinking head, whatever it is, the tactic that you're using, it's probably a good thing. And that's part of why I think tech is a little like not interesting right now, because most people are just waiting it out. The other thing that happens is if you have like inefficiencies in your company, you can now actually fire people without it feeling like the company is going under. Like no founder ever wants to do a headcount reduction or let people go in any material way in a boom, because it looks like everything's going to shit and then your employees start to leave. But here you've got air cover, right? You can point to, well, look what's happening everywhere else. And if we do like a 5 to 20% headcount reduction in areas that we probably overhired, no one's going to look at you weird during this weird window. And so you have this unique opportunity as a founder where you can actually like right size the business without collapsing your culture. And that's usually what founders care about.
No, and I think that, I mean, for the most part, I don't know what percentage it is, but for the most part, there is a bottom 10% at least of every company that's probably running a little less efficiently than it could otherwise, right? And to some extent, like I've seen businesses that have actually done layoffs and accelerated growth just because of the bloat in the org, right? It's like there's too many middle people that are slowing down communication right along the way. And so managing out the bottom 10% actually leads to both bottom line and top line improvement, right? But it is interesting. One of the things, I mean, in general, and this is the kind of gets lost in like the whole ethos of focusing on valuation and I don't know, the hubris around that, both from a, existing investor standpoint, wanting those markups and entrepreneurs wanting to be able to sell the vision, is ultimately like surviving is kind of the precondition to succeed at all, right? And we're working on our mid-year letter to the LPs, and like that seems so self-evident, but in the time of like abundant capital, you start to lose the plot a little bit on like what's going on. And we're talking about, like, at the end of the day, what are we talking about? We might be talking about a point, 2 points, 3 points, 4 points, 5 points of incremental dilution, right? Like within the margin of like what it would take. Oh, we would have been this, but now we're going to be this. Maybe you just raise a little less capital, fix the dilution. And like, it's actually not that big of a deal when sometimes the alternative to this is like not making it, right? And I think in the last couple of years, like, the egos of everyone involved started to focus on like just the high level valuation number and the implications for all of that. And now it's just kind of like, I don't know, get the money in the bank, right? And I've been trying to tell all our companies to do that.
Yeah, I mean, it's funny. The first thing, this is part of the benefit of being an angel investor and not being a board member, is you can have these more serious, honest conversations with the founder. Cause I don't own enough of any of these companies where it's going to affect me personally. So I can just tell them the truth.
Yeah. Knowing you, I get the feeling you're not going to tell the truth. I think you're going to do that regardless, but I think you have the credibility of being able to tell the truth.
Yeah. I mean, I will try my best to tell somebody when I think they are wrong. And I think that's come out. But like a lot of times what we end up talking about first about any of these companies when the founders call is just, do you have a good company? Like, do you act like objectively, is your company good? Because like, you go through being a founder and you spend all of your time selling. You sell to investors, you sell to customers, you sell to employees, you sell to your management team, you sell to like the culture of the business. Like you're always telling the story. You're always telling the positive version of the story because that's your job, is to like not run out of money and to, create a little bit of momentum. But you still have to think about the financing strategy objectively. And it's actually very hard to like switch gears from sales mode to like more rigorous finance mode, if you will. So actually a lot of what I spend time with the founders on when I talk to them is just like, let's throw the salesmanship out for a second. Is this a good business? And if it's a really good business, you have a lot of optionality because once the markets get liquidity again, once people start, to invest again, you'll be perfectly fine. And so all you're really doing is like bridging the gap. If things aren't going that well, or it's too early to tell, or if it's really not a good company yet, or you have like real serious downside risk, then you got to start to think about padding the balance sheet sooner rather than later. Because the closer you get to cash out, the harder this is going to get. People know when you're backed against the wall. And so most of the conversations start with like, where do you stand in that spectrum? And it's a really important conversation for founders to have that I think it's hard for them to have, because who do you have it with? Like, who do you talk to about this?
What's interesting is like when you're at the early stage, and I've seen this with executives that have had a bunch of success and then they go decide they're going to start a company, right? And they've been the chief product officer of some high profile thing, but like they've never actually been an entrepreneur. And their default alternative is actually a very comfortable, well-paid existence, right? And then you go and be a founder, which in a lot of cases can suck. I mean, you know it way better than I do, but it's a very manic existence. And to some extent, one of the reasons I like investing in young people is their alternatives to, their next best alternative or something is like being a rank and file executive at like a rank and file person at a company. And so they just like keep slogging ahead because they're not going to go get a 7-figure payday and a 10-figure option package to go work at a FANG stock or whatever. But to some extent, like once you're down the path, this is going to be a very interesting thing, is like past the point of just able to shut down the business or sell it for parts or whatever. I think I'd be interested in your take on this. So like, let's say it's a Series A, Series B company, right? And it's probably a tier 2 or tier 3 business. And one of the things that I think is going to be very interesting, and you've been talking to LPs, and I talk a lot to our LPs, and as the tide of publics has pulled back, right? The private market hasn't been marked to the same extent that the publics have pulled back, and so their exposure is different, right? And so if they wanted to be 10% privates, now they're 15% privates or whatever, and maybe that'll correct at some point when marks come down or whatever. But at the end of the day, there's going to be a triaging. There's less dollars available. And so ultimately, you're going to have to make a trade-off of like X tier 1 fund that we've been in for 10 years, right? And Y tier 2 fund that we took a flyer on. And ultimately, the tier 2 funds are going to get cut out, right? And so I think at some point, like those tier 2 funds, I think this is going to lead to a consolidation of power to the people at the top, right, that exist. And then incrementally now, the dollars are going to dry up for those tier 2, 3 businesses that like otherwise ultimately could have gotten funded in a very meaningful way, right? But like now those dollars are potentially not going to be available to them. And so I guess my question for you would be, if let's say you're having that conversation with an entrepreneur and it's a good company, right? Like it's solid and you can see a path, if they put their heads down, cut, burn or whatever, maybe it ends up being, they get back to the last round post and can sell it for that price, or maybe they can 2x it or whatever. As people are having that realization that they have a solid business, but it's not a, Stripe or whatever, what are you telling? Are you telling them just to get whatever cash you can, hunker down and like fight to get to, as far as you can take it? Or are you telling them, hey, maybe entertain selling now? Like what's that actual conversation look like between you and them?
Part of it is just like, this is not something you did, right? This is just like a reset. So
mommy and daddy, it's not your fault, honey.
Yeah, like, I'm sorry, shit happens. And then I think the second part of the conversation is kind of like, suck it up. You know, like, you can cry to me. I'm happy to be, someone who listens, but that's, at the end of the day, you need to just suck it up and like, welcome to being an adult. And that means at some point, taking more dilution than you want, raising money at lower prices than you really thought, owning less of your own, whatever. There's some outcome that you didn't love, but like, so be it. Because actually, I think you kind of nailed it. The alternative, and I've had this conversation, is like, do you want to do something else? Because that something else is going to be basically like a director of product at some giant company.
Yeah.
Like, do you really want that job? You're going to kill yourself. And so I think most people, once they understand the alternatives, eventually realize like, all right, let me just go make this work. And they fight through it. Look, if you have an M&A offer that's legit and it allows you to take cash off the table and you're not super confident in the company, I would generally advise people to strongly consider it. The number of times where that is true, where there's a legitimate M&A offer that isn't like SBF buying your company at 1/100th of the last valuation, is pretty rare. Like, it doesn't happen more. It happens significantly less frequently than people think. You just hear about it when it happens because it's very public. Most of the time, it's just like a tough unwind of a business if it goes under. There's somebody right before the podcast tweeted the picture of SBF like lying on a beanbag in his socks or whatever he's doing, basically saying like, this is the last picture you see before they buy your company. Like, it's just, I was truly laughing out loud at that one. And that's what happens. You get people who are unbelievably smart like him, and kind of aggressive, and sometimes you're going to get taken advantage of.
Yeah.
So, anyway,
this is at a macro level. Like every company, almost every company, maybe not Stripe or something, but like almost every company has gone through some existential crisis. And a lot of times it was execution related, right? But like some point of serious doubt. And I just pulled up, the companies I track by market cap, and just looking at, some of these off the top of my head, like Facebook obviously had the whole mobile thing that a bunch of people were doubting them and their stock price is way in the tank post IPO, right? And then Netflix has gone through like 6 different versions of that. Uber, obviously. Snowflake at the Series C, the round after. So we did the B at like 60 post, and then Altimeter came in and did the C in the round after that. But that was like a really, really hard round to get done. And like, running tight on cash. And, everyone thinks about that now as this huge up into the right story. But Datadog Series A was a really tough process, right? Like all these companies go through some level of it. And so I guess I don't know if there's any consistency of grit that these entrepreneurs have. I wonder, the one thing that I've been thinking about is how many of the entrepreneurs are in this for, like, it's been sexy to be an entrepreneur. It's been sexy to be a VC as well, right? For sure. But like, how many, now that things are going to get hard, how many people are actually in it for the reasons that they're going to be able to slog ahead and just like willingly galvanize the troops to get to where it's going? Because Ben Horowitz always has that like wartime CEO versus peacetime CEO. And it's sort of like everyone's going to war right now, like 100% of people. And so I don't know the answer to that. It's some of these things that the tide brings out a lot of stuff, right, to see what's exposed. And yeah, I wonder how even rank and file employees, now that their options are maybe underwater or whatever, like, were they actually in it because they loved the startup, or were they in it because everything kept getting marked up 3, 5, 10x in a row and they thought they were going to be rich?
Yeah, some people have it and some don't.
Yeah.
And you really don't know until your back's against a wall and you've got to fight through. I mean, you're doing like 5 things at once. That's the thing you have to remember as a founder is like, we see one piece of it, but what's going on behind the scenes is they're dealing with attrition in the executive ranks. They're dealing with employees wondering if their job's going to exist. They're dealing with customers, holding on contracts. And they're also dealing with the financing and the dilution and the psyche shift. They're doing all of this at once. And that's why being a founder is so difficult, because you're kind of managing across like multiple work streams at the same time. And when they all go wrong, they kind of all go wrong at the same point in time. And you're going to see a bunch of people who can't do it and just give up. And then you'll see the great ones, and even the good ones will fight through. There's one always, and nobody likes to talk about this stuff because I find they're like the hidden secrets of venture. But one of those hidden secrets is that if the company is successful over the long run, even if you fight through the 2-3 years of crap, if you're capable of fighting through it, the board will give you another equity grant. Like that's the untalked about little trick that everybody knows, which is like, all right, take 30%, 40% dilution right now, but guess what's going to happen? Like when you fix it, the board is going to issue you another X% of your own business. Now it's going to be at a slightly higher strike and it won't be worth exactly the same.
And you'll have to revest all of it and blah, blah, blah. But yes,
you'll kind of be made whole,
Yeah, no, that's right. And that's one of the things. It's an interesting thing. We're so beholden to founders, right? And their desire and willingness to go the distance. Like, I'm not going to go parachute in and run any of these companies. And so keeping them incented to not say, fuck this, we're recapping the entire business and I could just walk away and go raise a seed round at a higher price from someone else, right? It's actually in the interest of the investors to have executives that are motivated to keep going, right? And so, yeah, you're right. As these rounds happen, and we've obviously, I think we're both buddies-ish with Aaron Levy, but like what he's been able to do from being like the cool, hot, sexy enterprise software company to like just the slogging ahead, building a $4 or $5 billion public company. It's actually a really inspiring story to me of like when the sizzle wears off, what you go, someone that's just like plowed ahead and kept at it, right? And I'm sure he had grants along the way that got re-upped because he had ratchets and all this bullshit, right?
Yeah, and this is where some of the incentives in startups are not always perfectly aligned, where, most of the employee base never gets that re-up. The executive team does. And honestly, sometimes it's not even just the executive. Sometimes it's just the founder.
Yeah.
And, I've seen some bad behavior previously to this of like firms coming in and offering late stage, highly dilutive rounds, more than the market would want, with this like hidden handshake that we're going to give the founder like a re-up grant, basically.
Oh yeah, totally. No, that happens. That actually happens a fair amount of like, hey, We'll screw over your existing investors and dilute down the employees, but you're going to get an extra point on the post money or whatever, 2 points in. And it's kind of driving a wedge to incentivize the founder to go with you. I mean, it's a clever, if kind of dirty tactic, but yeah, people definitely do it.
Super dirty. And I always see it have this like very conflicting outcome almost, because like, the reason usually I know about it is because the founder has called and said, hey, here's what's going on. And I'm like, well, as a founder, that's pretty cool. Like, I appreciate it. Let me give you my advice as a founder. As a investor in the seed round who is going to get destroyed by the dilution that's happening here, like, I don't really love this, but that's my honest take, and you will make the decision that feels right for you. But yeah, it's a little subtle. Like a lot of these crazy valuation rounds, or even the crazy recap and dilutive ones, honestly, on like both ends of the spectrum, there's all these like behind the scenes mechanics that happen that make the founder a little different than the rest of the company. if you will. Like, it's just a different dynamic.
I mean, he'll probably hate me saying this, and hopefully he doesn't listen to this episode, but one of my best friends is Bill Magnuson, who's the CEO of Braze, and I'm actually interviewing him tomorrow, and I don't know when we're going to run it, but we were investors in Braze, and now it's whatever, a $4 or $5 billion public company, whatever it is. And he was a founder, but like through a bunch of machinations that maybe he and I will talk through. At the time of IPO, he had like 3% as founder CEO. And and I was kind of like, dude, like this is on the low, like you're at the bottom 10% of founder CEO going public, right? And I was like, it's a very reasonable ask to go to the board and ask for a little bit more. And there was a bunch of examples of people doing that. And he, 3% of whatever, 3, 4, 5 billion is still a lot of money, right? And he was like, I just can't look our rank and file in the face and say, hey, I was able to do this and you guys didn't. And I was like, right, I get it. But you started this, and like through a series of events, you got kind of hosed. And he was like, I just can't do it. And it's not to judge people that do it, because I was actually advocating for him to do it. It's just like he was so such a purist about it, right? And so I have more than enough money. I will be fine. We'll appreciate the stock price. I will be more rich, and I just don't think it's fair, right? And I just like have so much respect for that mindset. Not to say it's like the only way of doing it. If you take a grant, it doesn't mean it's the negative. But
well, the best way, I would say, like the corporate governance way to do this, if you want to be objective about it, is what's the replacement cost?
Yes.
Right. And that, I think, is a very legitimate exercise that aligns incentives across the board, which is...
And you're probably a public company CEO, you're probably giving 3, 4, 5%, probably.
Yeah. And I think that's the right way to do it. Like, once you're fully vested as the founder and you've got your cash comp at back to, like, probably not at market, but like market-ish, and now you're going, all right, like, what's my future incentive besides the equity that I own? Yeah, you do an exercise of like, if I quit today, what would it cost the company to bring in somebody of equal or even potentially better caliber of operations? And yeah, that's usually 3 to 5%. And if it's an earlier stage company, it might be more. And I think that's like a reasonable anchor and starting point for a conversation. It doesn't have to be that exact number, but that's kind of how you want to do it for employees as well, which is like, I want to pay people slightly above the replacement cost, actually, because it costs me more to replace somebody in terms of like institutional knowledge and stuff like that. But that's the right way to think about compensation, in my opinion, which is, if you quit and I had to replace you, what's it going to cost me? And like, that's probably how much I should pay you plus a premium.
Yeah.
So
one of the things, I guess, a slightly different thread on this, just because we were talking about it earlier, but so you have been a founder. I think Dixon said former entrepreneur, but I think you still would be considered, you're an entrepreneur to me still. So
I always like being called a former entrepreneur by a former entrepreneur. You know what I mean? Like, is that an insult? Like, it's like, did you look in the mirror? But maybe it wasn't directed at me.
I personally think you're a professional talking head at this point. But that's how I would characterize you. But so you've seen, and then you invest. I mean, you guys you're pretty thoughtful about product market, right? You're not necessarily doing product market fit post-investing, but you guys really think through the product market of what these founders, you're not like, hey, this is just a badass team, right? Is there characteristics now, as you're thinking about companies that have that are coming across your guys' plate, characteristics of founders in this existing market that you're hyper aware of, knowing that like we're in sort of a more choppy time, and so this characteristic is now a need to have, whereas in the go-go sunshine pumping, cotton candy and rainbows and bubblegum times in the last whatever couple years, that it might not be necessary, but now you won't do a deal without this?
So we've always focused on, look, it varies by industry, right? So I'm going to give like a generic version of what we look for, and then there are subtleties and nuances if you're doing like dev tools separate from enterprise. But my thing is, like, great founders have 2 core characteristics that stand out to me. One is that they can stretch up and down, meaning they can, same person, can get on the phone and talk to you on the downside of like technical details. How does the product work? What are the use cases? What are the user stories? Like true product management stuff, like, which is in a sense my background. I think that's part of why I've been able to do the crypto stuff, is because I just understand product management. So I want to be able to talk to the founder about the specifics of the product and how it works and how it's built, and in particular, like where the advantage comes from.
And is this the single, like, is this the founding team or the singular, like, founder?
I really think the founder, and definitely among two people, should never be more than two to get to this, can do that. And they can talk about the up, which is the market. They can talk about the sizing and the competition and pricing and the sales motion and the story and all this. And, you know, sometimes both founders can do it. And that's usually where you win, is when like there's two people who can independently to get this done and you don't have to split it. We've always looked for that. We've always looked for like, can you stretch up and down in the same person? Because those people cut out middlemen from a feedback loop standpoint, meaning they can go talk to a customer, think about the feedback, and then translate it back to the product without having to go through like their head of technology or something like that. It's an unbelievable skill that a founder really needs to have. We've always looked for it. The add-on, I would say here in this market, is can you sell? Because can you tell like a clear, coherent story that's interesting to people who may not understand the details as well as you do? Because in the current market, you need to differentiate in the sales process, because like inertia is there to kill you, right? Like you're not going to necessarily die because of competition, but you might die as a company because your customers just kind of wait. They pause, right? We're not ready to buy. We're going to make it a 2023 decision. Now that like ability to sell matters in most companies. It doesn't matter in all. Like if you're doing true consumer stuff, it obviously doesn't matter. But for the majority of the stuff that I like to look at, which are more enterprisey in nature, that last piece I think is going to matter more. Can you get stuff over the line based on your just like brute force? Are you convincing? Things like that. So we've always looked for this stuff, but I think that part ends up being more important these days.
Yeah, no, it's interesting. I sort of think there's like some people can scale. I mean, the matrix of like consumer and enterprise, right? There's a handful of people that have ever done that particularly well. Like Peter Fenton obviously has done an amazing job at doing that. And then the like pre-product market fit, and then the post like, kind of growth-ish investing type, like those tend to be a little bit different. But I'm just always fascinated by the people that, are able to tell from a founder archetype. Like I sort of need the feedback loop from customers validating, and then I'll go assess a bunch of the other stuff, but like need the feedback loop because I've never been a founder. I sort of view all that stuff as black magic, right? It's sort of like, oh yeah, you get a product and then the product's out there, and then I can go talk to the customers and validate and scale and like see your leadership skills and scaling and all that stuff. I just haven't seen the journey from like pre-product market fit, idea stage past. And so it's always interesting. Your buddy Keith Rabois has like very interesting frameworks about like the types of characteristics and like having people that like really spike in singular dimensions, right? Yeah. And not trying to get liberal arts type skills, but instead having someone that's like a one of one and doing one specific thing. That can really stand out.
The funny part about Keith and I, we don't even really know each other, even though we got in that little tiff about healthcare.
By the way, so buried in your notoriety. I mean, that's got to be the crypto thing. If there's been any real benefit to you, it's like, I think that's people have totally forgotten that you were the Keith Rabois guy. Yeah,
well, there's a little bit of a and then I'm going to compliment him in a second, but like there's a classic, I'm really good at this one thing, and so I think I'm really good at this other thing, and then you're kind of like out of your domain and discipline and healthcare.
Just for context, by the way, Rashad just sent me a note being like, some people aren't going to know this, but you at the beginning of the pandemic, you and Keith got into a little bit of a Twitter spat. Actually, one of my original like viral tweets during the pandemic was, it said something social distancing, and it was the picture of you two next to each other, and you guys got into it, like dominated the tech cycle for like 36 hours on Twitter. I feel like at a time that we were all really bored. Everyone was just like trapped at home, super bored, and it's like these two people are kind of like warring with each other.
we got into this discussion in healthcare, which is very nuanced and has to do with like understanding of a specific type of statistics that you have to apply in like, does a drug or any intervention, a medical device, a change in behavior, whatever, does the thing actually work? And how you measure whether it works. Because we have a history in healthcare of saying something works, and then when you actually test it, it doesn't. And actually, more importantly, is it's harmful.
Yeah.
That's the thing you have to remember in healthcare, which is like you can do things that make it worse. And a lot of like engineering software types, the worst thing that happens is your software doesn't work and it never gets worse. You might as well just try it. But in healthcare, actually, you can do things that are detrimental to somebody's health. And so you have to be very careful about deciding whether something works. And there's a science of this, which has to do with like randomizing data, basically, right? I'm not going to go into all the details, but there's this underlying idea that if the data that you're using to measure whether something works is not randomized, then there can be inherent bias in the analysis. And actually, where him and I disagreed, and he was wrong, is that when you add more data, if the underlying data is biased in any way, it's not that you get to a better answer, you actually get to a worse answer. You get more biased data. In software, and when you're doing like normal data analysis stuff, you actually want more data because you're looking for a signal in it. But here, more data isn't helpful unless the underlying data is randomized. And we got in this giant little tiff about it.
And you know some things about healthcare, right? Like you have some credibility in that world. So
look, this is one thing where like I literally spent like years of my life because it was tied to what Flatiron does and doesn't do.
Which at some point we need to do like I don't even really understand Flatiron that well, but needless to say, you know a little bit about healthcare.
Well, to tie it back, like Flatiron's underlying biggest challenge is that our data is non-randomized. And it was funny because I was arguing the need for randomized data, even though the company that I built and started and sold was working on non-randomized data. I was essentially arguing against my own business, which I thought gave me some credibility here. And we got in this whole tiff, and he was definitely wrong. And he was like trying to show whatever, that hydrochloroquine or something was effective, and it's not, and it probably is harmful. Anyway, the thing that I actually think is funny about Keith is that I've used some of his like operating frameworks in my own day-to-day. He's actually like a remarkable operator in the area that he knows. And I always loved the thing about him was that he was just like very good at saying, you're good at this, you're not good at this, right? It was very, no bullshit about like, everyone can be good at everything, which is totally not true. And he had this little lecture he gave that I used to show, he doesn't know this, but I used to show it to our team at Flatiron, like the exec team of like barrels. He had this like analogy of basically barrels versus ammunition.
Where is this on YouTube or something?
He gave some startup lecture at YC that I thought was really good, which was basically like a lot of startup hires are ammunition. You give them something to do and they do it exceptionally well. But if you give them like open-ended problems that they have to kind of organize other people around and coalesce around a strategy and drive it forward in blank space, most people are very bad at that. And if you find someone who can do that well, he would call them barrels because you can kind of like shoot through them. And it's a weird analogy, but it works. Those are the people you continuously give like bigger and bigger scopes of work. And I always thought that was like a really phenomenal way of thinking about like what makes a good startup hire and what doesn't. And then we got in this like stupid little Twitter beef, and I don't know.
I've tried. At some point, we'll make him. I've invited him on. I think he's been reticent or busy or uninterested. But I think you guys have invested in stuff together too since then. So it's not like
multiple things. And it's always so funny with the founder. The best part is usually we're the seed investor, and then founders fund comes in later. And sometimes it's not the case, but sometimes it's the other way around. And I'll always get a like, hey Zach, we're doing this round. It's led by Founders Fund, and Keith's joining. So, like, I just wanted to let you know that. And I'm like, I don't have some long-term vendetta against this guy. I think he's a great operator. I think he doesn't know anything about healthcare, and like, I'm happy to have that debate. And I'm sure there's a bunch of stuff that I'm really stupid about that he knows a ton. Like, I don't know, the details of fintech or something. But people, I think, assume because we got in this like public argument that like we hate each other, and like I don't hate Keith Rabois. He's perfectly fine.
Yeah.
You know?
Yeah. Well, I'm in the middle. Like everything else, I'm just shaking hands, playing neutral, just facilitating drama, but trying my best to stay out of it. It's a role I've been able to play fairly well with you and Keith as fire starters here.
happy to be the person that says something that gets themselves in trouble.
Ben, David, thanks for joining me. I am here today with the guys best known for Acquired FM, one of my favorite podcasts. Thank you guys for coming on.
It's about time. I will say, I can't believe that you've done so many episodes and it hasn't been with us. I'm just offended.
Yeah. I was thinking, as you guys have maybe seen, this has become a podcast for people going viral for like misspeaking, like our mutual friend Packy McCormick.
I can't wait. Yeah.
Or like airing past grievances, like Parker Conrad did. So I'm excited for you guys. You either need to say something that like gets you viral on Twitter, or you need to like really bury some past slight and go after someone. So that's like my expectation of all guests here.
I'll sharpen my shiv. That sounds perfect.
We're lucky. We're a history podcast, so like the story's already done when we do it.
Yeah, exactly.
This is new for us.
I can't imagine too many people listen to this podcast and don't know what Acquired is. But maybe for the people that want a brief primer on it, can you guys just share a little bit about what Acquired is as a podcast?
Yeah, absolutely. So Acquired is a 7-year-old podcast that chronicles the stories and strategies of great companies, one company at a time. So one company every episode. Episodes are reasonably few and far between, only every 3-ish weeks. They're long. They're like 3 hours. So our goal is to do an exhaustive look at and leave, no stone unturned. The only stones that are unturned, you would need to like write a book to really capture. But to give like the definitive history of companies and analyze their position today. I've done about 250 episodes. What am I missing, David?
I mean, basically our goal is to be the hardcore history for business.
I'm a huge fan of what you guys have done. And I think one of the things that I've loved is you just synthesized a lot of things that I'm curious about, or things that I don't even know are interesting, into a very digestible format to go through and kind of get the definitive history of all this. So I guess talk a little bit about, like, how did you land on this? Was this an evolution? I know Acquired by a name, it was originally about acquisitions, right? So like, What was the genesis of you guys doing this?
Totally. And it turned out it was just a really good name for many reasons. Biggest of which being that most podcast players sort shows alphabetically. So ACQ is good SEO for podcasts.
Yeah, I'm going to be $ cartoon avatars.
Yeah, nice. There you go.
Yeah, just to try to get one above you. Yeah.
Yeah, it was not, we started in a different era. We've gone through so many iterations of Acquired, of the whole podcast ecosystem, of venture, of tech. We started in 2015. I was thinking about this. I was looking at the outline. When we started, Ben, remember, I didn't even listen to podcasts. I think in some of our early episodes, I'm like, I don't listen to other podcasts. I don't know what I'm doing here. We were just young and stupid.
Yeah, it's 2015. I mean, the inception of it was over drinks in February of 2015, and our first episode actually didn't come out until October. So like any good project, it was like, we should totally do this. And then the idea dies 4 or 5 times over email threads until you get less busy.
So was that time spent, like, actually, how much of that was prepping for what it would become and the strategy of it versus just inertia and laziness?
0. Mostly procrastination.
But 0.
Here's the real story behind it. I felt like a massive imposter because I was working at Madrona Venture Group as not a VC. And I think the great career advice for anyone is only ever work at companies where your thing that you're doing is the core competency of what the business is known for. And David was like a real live investor. He was a principal, just come out of Stanford, doing the GSB thing, had lots of investments. And I was doing this like labs project in the corner where I was the programmer for Madrona Labs, incubating sort of one company at a time. And
Ben is being very self-deprecating here. Right before he joined Madrona, there was a front page weekend edition cover story in the Seattle Times about how Ben was the future of Microsoft. So
it actually was not weekend edition. It was Monday edition. And I know this because it came out the day that I resigned, which was not intentional, but an embarrassing, kind of terrifying thing to go into the office when my boss is holding up the front page of the local newspaper and I'm handing him I literally wrote a resignation letter because I didn't really know how you're supposed to quit. And so we traded pieces of paper.
Wait, so why were you, what was the future of Microsoft, you being that? I mean, obviously it didn't actually happen, but what was the article based on?
Think of what could have been.
Yeah, Satya Nadella, you would not know that name if Ben hadn't left.
I'm confident that is not true. I ran the Garage program, which was this like internal incubation factory inside of Microsoft. And I had just been a user experience PM on Office for iPad, which was this big counter strategy thing that Microsoft was working on that was actually part of the CEO shakeup, because the sort of old company strategy was Windows first. The new company strategy was cloud and mobile. And, when you want a cloud first strategy, you need to be a great experience on every mobile device. And so by building Office for iPad, which was like a 3-year undertaking by a 200+ person team to build a product we were like super proud of, managing to actually bring full fidelity documents to a very underpowered iPad at the time. I think the iPad 3. It was like a gigantic lift that was completely opposite of the company's current strategy of do everything to promote Windows. So that was like that was a fascinating career moment to be caught in the crux of all that.
Yeah, famously a strategy that they had to unwind, right? I mean, that was kind of Satya's big day one initiative, right? Is sort of not being Windows first. But yeah.
How much market cap has been created by not being Windows first?
I know. You can define yourself in a lot of different ways. It's so you were actually working on the future of Microsoft in a quite literal sense versus everyone else kind of that doing the Windows thing.
I was answering the question of like, what should the ribbon look like on the iPad, and like writing very long spec documents to make that happen.
So you guys overlapped in Madrona, and
so I was like, how do David and I had like gotten drinks and coffee a couple times, and I was like trying to. We weren't really friends yet. We were kind of acquaintances, and I was looking to like, I was looking to lock it down. And
how long on the job?
This is so funny. I never had this perspective. I was like, oh, Ben's awesome. I want to hang out with Ben more.
9 months in or something like that. David had come back fairly recently from business school, but it was...
I was at Madrona for a couple years before business school, and then we were talking about Meritech before we started. Amazing folks. I worked at Meritech during business school and then came back to Madrona. Yeah, so that was this era.
The Meritech guys are great. But yeah, so Ben, you're ready to DTR. You're ready to like, hey, David, this needs to be a thing between the two of us. And are you actually brainstorming like, what was the inspiration? Are you brainstorming how I get this person to make it official with me? Go on Facebook and define the relationship?
It wasn't really that. I think it was like I was actually a little blindsided when I was. I always keep this text document. I'm like very old school and use TextEdit as like the way that I take notes. And so I have a thing called ideas.rtf, and it's ideas for blog posts when I used to do more of that. It's ideas for apps that I want to build. And I had like a little running list of ideas for like small media companies. Like, wouldn't it be cool if there was a podcast on this? And I was pitching David, and there were 2 different ideas. And the one that sort of one was, I was like, do you think this is an interesting idea? Would you listen to this podcast if, we're in the business of starting and investing in companies, most of them get acquired. It would be cool to understand like when those go well, why do they go well? Because it seems like the rare case. And then we can use that to inform investing strategy. And in retrospect, that was kind of wrong. That's like how you build small companies. But I think that one, David, I was like shocked because immediately you were like, I will absolutely do that with you. Like right on the spot. No. Like,
well, and it was more, it wasn't about the idea. It was a bad idea for a podcast. We did it for like 10 episodes. But it was about, the magic. Like, it was the right time. It was the right time to start a podcast. We were great friends. We had great chemistry. And it was like, yeah, let's see where this goes. And I think also, I think the thing that hooked me about the idea, and then now what it's evolved into, was I had just been in business school, and you do these cases in business school, and like, I hated them. Like, they sucked. Business school case studies suck. If anything, like, to me, Acquired is the like, that was like the germ of what, sparked it for me. Like, how do you make this better? They're written, so pedantically. They treat you like you're 2 years old. I'm like, I'm smart. Don't treat me like a 2-year-old. And so I was like, oh, this would be a cool way to explore what otherwise would be a business school case study in a much more real compelling way. We work in the industry. We can talk about what really happened. And yeah, here we are.
Had you guys been students of like business history before this?
I was not a student of business history. I was definitely a student of tech history. Like, part of what made those early episodes work was that we sort of can remember where we were in the moment where these things happened. Like, I remember working at Cisco and reading about the 2008 financial collapse and wondering like, how's this going to be for my, like, what, am I going to get an offer here or not? Or like, I remember watching the original Steve Jobs iPhone keynote like 6 times. And I feel like I didn't know jack about business models or defensibility. Like, Acquired has been my MBA on that front. But a lot of, I think, what makes the show work and what made me passionate about doing it originally was like exploring. When you think about the fact that we all use these mobile phones and we have the internet, it's kind of amazing that through the experiments of history, that is the sort of surviving thing that became successful. And I'm always fascinated by like the pivotal moments of like, what made the information superhighway fail? Why didn't AOL win? You know, and remembering the moments when big news dropped and thinking about where I was and contextualizing it in the moment feels like a big piece of why the show has been relatable for people.
Yeah, it's interesting. You know, so my real first job, I was at Deutsche Bank for 2 years, and then I went to go work at a boutique investment bank doing like sell-side advisory for software companies. And it's funny, when you're doing advisory for software, you're not really entitled to your own opinion about like, unless you know the history of databases, you're not entitled to an opinion about like the next gen database, right? To some extent. And so my little hack that I had was like figure out the history of how software came to be and like all the businesses that were formed and all the controversies and all the personalities and all that stuff. And so I went back and studied all that stuff so that I could drop little anecdotes about like the database wars, right, of the 80s. And you know, or like...
I still haven't read the Oracle book.
Yeah. Which is a great book. Well, the one that I like, I don't know if that's Soft War. That's the one
Software,
that Yeah. It's a really cool book for people that haven't read it, but they go through and like the author got total access to Larry Ellison, but Ellison said, based on what you write, I get to write footnotes that say, hey, this isn't what happened, right? And so I've never seen a book like this.
Ben, we got to do Oracle and do that book.
Yeah, the author will say like, Larry did this, and Larry will be in the footnotes being like, that's not how this happened, you know? So it's pretty funny. But yeah, so I read books like that, or like, you know, the quick and dirty operating system story of Microsoft and Microsoft DOS and like the IBM project down in down in Florida.
That's a crazy ass story.
Crazy story, right? And so in Boca Raton, right? It was like a laptop group down in Boca. And so like I knew all these little things, and that's why I've loved your podcast. Is I guess mine's sort of the business strategy around tech, and I can go.
And for you, it feels like the people too. It feels like with your background and your personal passion areas, it's like, how is this set of people who all have all these agendas, how is that like the Holy Roman Empire? And I'm coming at more like, wow, how did this widget become so powerful and allowing someone to control the world? I'm focused on the widget.
Yeah, exactly. And it helps you understand. I do think, I mean, understanding history, you don't want to overly extrapolate those data points. And this is the first, I was coming out of college, probably not dissimilar to you all in the financial crisis. And you know, I remember it. It didn't impact me at like an emotional level. I mean, it made it harder to like get jobs and stuff. But like, I didn't watch my life savings go to nothing. I watched my parents' life savings very impacted, right, by all that. But to some extent, knowing that and how all these businesses fared is super informative to now, and knowing the history of the internet bubble. I also think there's something about like being able to throw that out, because every crisis is kind of different. And so it's almost like, you don't want to overly extrapolate historical events forward, but like knowing they exist is just super helpful in framing, you know, the history of software is informed by all the anti-competitive stuff Microsoft did over the years, right?
Totally. Well, it's not, you know, what's so history period, but especially in tech, like it's always different. It's always changing. It's always different this time. But what I think the value in going back and studying this stuff to me is funny. I'm reading Sam Walton's autobiography now, Walmart, and I'm just reading. I'm getting all these ideas, and I'm like, holy crap! Like he did this stuff, 60, 70 years ago. It's kind of been forgotten to history, but like, what would that look like today? Like, what could I try in my XYZ founder? What could I talk to people about? Like, obviously, it's going to look different, but like, these people were so creative in the past. What can we learn from them?
Totally. Yeah, it's fascinating. So the state of podcasts, I mean, obviously for me to start one in 2022, it's very...
are you insane?
It's much more...
Yeah, okay. We got to talk about, talk about your story too, and like...
Yeah,
keep going.
I'm happy to do it. I'll give you my perspective, but I would love to hear, what was the state of podcast? Like, were there things you emulated and said, hey, like, this is similar to what we're going to do?
It was so different.
Yes. So you wrote this in the outline, and I was trying to like give it some real prep thought to beforehand. I think there was this very significant chasm that we didn't realize was there. And I often wonder, do all founders kind of feel this way, where they just were interested in something and then didn't realize it would be a large market? But a thing that was well established that I spent thousands of hours of my life on was like Apple nerd podcasts. Like I listened to every episode of Daring Fireball. Yeah. I listened to the previous version of Daring Fireball when it was Gruber and Dan Benjamin. I, listened to every episode of Accidental Tech Podcast, and before that, Build and Analyze about Marco doing his iOS development. I mean, that was a well-trodden world. On the other hand, you had the highly produced NPR podcasts about business stuff. There's Planet Money predates us. And How I Built This predates us, but for a totally different audience. And I think Stratechery was written for the audience that we would end up serving with Acquired, with a totally different use case. And Ben is so brilliant. He's the modern day Michael Porter, and I think it one day will truly be recognized for that.
Your episode with him and Packy was so good, by the way. Like, it was so fun listening to that.
To some extent, you just get out of the way and let people go, right? It's like you're trying to pull stuff out of people, and then it's like, hey, I'm going to fade to the back of this. That's the way I feel now working with Zach Weinberg. But so you were looking at a bunch of those different things, and clearly it resonated at a personal level with you as well.
Yeah, and there's always been something. If I think back to ideas.rtf, like all of the ideas that I ever have are tightly scoped, and I think it's because I don't know if it's like my Ohio roots and now my Seattle roots, where I don't think like anything I'm going to do is like particularly world conquering. So I don't at the start be like, I'm going to start the next Walmart. It's more like, oh, I can clearly see the narrow scope of this idea and how it provides a lot of value to me and people like me. So let's just make that, and then we can like draw a nice box around it, and it can be like this amazing shiny object. And like my first app that did very well was that I made this app called Seize the Day, very minimalist to-do list manager that got 1 million downloads in the early days of the App Store. And like, I really like things that do one thing and do it well. And sort of that was the idea for Acquired. And I think it took us years to sort of realize, oh, the audience not only is willing to give us more leeway to do other stuff besides this tightly scoped reviewing and grading acquisitions, they actually want it. And I would not have, I probably wouldn't have started the show or certainly had the idea for it if it was tell these comprehensive company stories and analyze them, in part because in 2015, I was in no way qualified to analyze businesses.
It's interesting because you guys, like a lot of the podcasts that I think had early success, and we've talked about this a little bit in the past, but were much more ephemeral in nature, right? It's like they're topical, they're related to what's going on. Their shelf life is days, if not weeks, right? And you guys are doing such a comprehensive thing that persists, and you have to think through different considerations of that. Of hey, I imagine if it hasn't already, like there will be business school classes that are done with the centerpiece being your Acquired episode, right?
Yeah, Northwestern does that.
It's wild. It's happening. Yeah.
Yeah. Okay. Yeah, it makes sense, right? And And so it's just like, it's interesting to do something that's so different than everything else that was out there at the time. And ultimately, I was kind of pattern matching a little bit. David, you asked about what I was thinking through, and mine was...
You did Twitter for... How long were you like really active on Twitter?
Yeah. So my Twitter... So I was at Battery 2014 to 2020. And...
Can you say that, or are you supposed to say like another venture firm?
Yeah, no, I don't... I don't know. You know, I make all this stuff up, guys. As you've seen from my Twitter handle, there's not a lot of oversight around what's going on in my world. So I
didn't realize you were at Battery all the way through till 2020.
Yeah. So I left, I guess I joined at the beginning of 14 and left at the end of, I think my last paycheck was like, January of 2020. So the very beginning. And so my story there was like, I felt like if you go listen, before I started doing podcasts, the only podcast I had done was Harry Stebbins. I did it in 2015 or 16 or something. And one of the things that was like germinating in my brain at the time, and it's still, I've gone back and listened to it in the last, year or something, but it was this rise of celebrity investors, and not Ashton Kutcher type celebrity, but people that were known as a personality. I always thought there was like this flywheel between you did right by your founders and did right by your LPs, and then those compounded on themselves, right? And it's like, hey, you do right by your founders and your LPs, and nothing else matters, right? And increasingly...
Well, sure, if you're willing to wait 30 years, then yes.
Yeah, exactly. But increasingly, it felt like there was this little wrench that was Twitter being poked into that spinning wheel and saying like, hey, well, and Andreessen Horowitz deserves a lot of credit for this, where, hey, actually, there's this level of notoriety and celebrity and, resonance with entrepreneurs, either because they're also founders, or because they have a big platform, or they're very well connected, or they, whatever, all these things. And it was like, hey, that's not just the flywheel anymore. There's a bunch of other considerations. And so I was noodling on that, but I wasn't really sure what lane I was going to play in it, right? I was like a mid-20s, late 20s something. And so I had a Twitter. I probably had, 1,000 followers or something, right? And it was mostly like friends and CEOs or executives that I liked their tweets and occasionally replied to.
Are you tweeting like, congratulations to my portfolio company on their most recent fundraise?
So proud.
Yeah, exactly. Totally benign. And I made some jokes, but like we had a compliance department. And like, I was always, I don't know how many times I actually got called into the principal's office, but I was like nervous to be called into the principal's office, right? And so I would toe the line at times, but like not in a meaningful way. And then I joined Redpoint. So December 19, I officially like signed to come on board. And then I started March 2nd, 2020, which is a fascinating time to start a job.
Yeah, right.
And then we all went into a pandemic and quarantine for a while. And I was kind of bored and staring at my phone all day, as a lot of us were. And it just like, everyone was kind of bored and wanted to be entertained. And I was in that same boat. And finally, I was part of the principal's office, right? And so there was no like getting called there to the same extent. Like I have had my partners twice say something like, hey, can you not do that, right? One time was a very prominent investor who might have started Y Combinator sent an email asking if I was making fun of him, and I was in like spirit, but not in like intentionality. I mean, I see how he thought that, but it also whatever. And so that was like, hey, by the way, I was only like 4 months on the job at that point, and I was like, oh, that's the stove, and I just touched it, and like and so that was one, and then another one was when Mark Andreessen started tweeting in earnest. I made a comment like, or whatever, came back around and started doing memes. I was like, I can't believe the same guy that invented the web browser killed the meme. And it was like, do you really want to antagonize Mark Andreessen? And I was like, I mean, kind of, but I see where you're coming from. I'm like, that might not be the best idea for my career. But otherwise, they've given me a lot of latitude to like kind of joke around. And even then, it was just kind of like, guilt. Like, is that really good for our firm, right? That you're doing that? And there are, literally thousands of like controversial-ish tweets that I've never gotten anything said about. And so that started to resonate, and I tweeted in earnest, kind of unencumbered for a while. And then what happened?
Were you thinking, I didn't realize this was all happening at the same time you joined. Right point at the pandemic, you started to tweet. Were you thinking like, hey, coming in like, fresh start, repotted, like, I need a new strategy? Like, were you looking for something kind of new, or did it all just kind of happen?
I always had the anxiety of like, what is my place in the venture community going to be? Because I am a liberal arts school, business major that did investment banking, doing technology investing. And it's like, and I'm a white, straight male.
Wow, I've never heard that one before.
Yeah, exactly. Like I walk into J. Crew and forget who I am when the mirrors are all around, right? And so I was kind of like, how am I going to stand out and differentiate in all this? And so that was always an anxiety that I sort of had. I don't know how purposeful it was that like, hey, this is going to lead to something else. But I was bored, and you kind of get validation because things start feeding in the feedback loop. And so I just kept doing it, and I would get more followers, and it started to resonate. And then ultimately, after like 2 years of doing that, like to some extent, the audience you make is the one you keep, right?
100%.
And if they expect jokes when they come to you and you start deviating from it, it's kind of like I compare it to like in Wedding Crashers when it's like, no, make me a bicycle clown. It was like anytime I deviated from like a joke, everyone was like, that's not what I signed up for, right? I want the joke guy, right? And I get it because Twitter's algorithm kind of sucks. And so you're kind of force-fed, all of the stuff if you follow me. And so I was kind of noodling how I could branch out a little bit. I had seen your guys' success. I had seen the success of All In, and it kind of felt like, hey, why not try? The insights I had was like, if there was this was a little more strategic. The Twitter thing was accidental, but the strategicness of the podcast was, I thought that the way tech is going to be covered is similar to the way Hollywood started to get covered in the 50s, 60s, 70s, politics in the 80s, 90s, sports in the 80s, 90s, 2000s, where people sort of follow the personalities and the palace intrigue, and to some extent, like, how powerful these businesses have become. It's to some extent, just a Twitter, to some extent crypto, to some extent Robinhood, meme stocks, to some extent whatever. Like it's all of this stuff has kind of manifested itself. And so now you have Elon Musk covering SNL, right? Or on SNL.
You're right. Yeah, these people have become mainstream celebrities in a way that 5-10 years ago was not the case.
And the insight that I sort of felt like is I still feel like an outsider. Like by every definition, I'm an insider at this point. But I still sort of feel like I'm an accidental VC in that, like, I went to a liberal arts school in Virginia. I didn't know anyone in VC or technology. I grew up, my family's all from Tennessee and Alabama originally.
You live in New York.
I live in New York, yeah. And I've never lived in the Bay Area, which is crazy. And to have been in like tech ostensibly since 2012 and never once lived in the Bay Area. And so I still sort of feel like an outsider, that I sort of fell into all this. And so my thought was, and then I'm about as young as you can be and be senior within the org, right? And so I felt like, hey, I still feel like an outsider. I'm young enough and relatable enough that I'm not sitting in some like colossal mansion somewhere. Like I'm still, I should be fine in my life. Like no one, but like I don't own a house, right?
Right. You're not recording this podcast like with a full Zoom room set up in your home and a telephoto lens 8 feet away.
Exactly. I'm in like a 1-bedroom. I guess it's like kind of a 1.5 bedroom apartment in New York, right? It's nice. It's great, but like I don't own it. I rent it.
You don't have something to lose.
Yeah, and so that was kind of those two things together sort of felt like there was an angle for me. And then the Twitter thing was beneficial because it gave me access to people that Parker Conrad came on and told the Zenefit story, right? And how did I get to Parker Conrad? He had followed me on Twitter for like 2 years or whatever. And like, I didn't know him, but he was positively inclined to me. And so that sort of gave me a little bit of a network. And then,
you know, that study in Thinking Fast and Slow where they subject a group of people to a list of planted random names in fake news stories over the course of a couple months. And then they give them a list of people, I think ostensibly that they would be voting for, and half the names have been planted in those news stories and half are brand new. And almost everyone rates the names that they recognize, not good, not bad, but just they recognize as more trustworthy, as someone that feels more competent to them. Like, recognition is real in terms of like getting people to be positively inclined toward you, no matter how they heard your name.
And that was honestly, I mean, we were in this like 2-year mania of, I would love to talk about State of Venture in a minute with you guys.
Oh, it's over. It's done.
But we were in this period of like, I joke, one of the things I used to tell people is I started my job as a hedge fund analyst and ended as a Hollywood agent, and I was a VC the whole time. And like,
that's well put.
My job used to be like numbers and like analyzing and all of that. And then it became like, I actually went, one of the Ramp guys, the co-founder of Ramp, Kareem, I actually went with him and his wife after we had brunch together one day. And I went with him and like, we walked through the house that they ultimately bought. And I was like touring it and checking stuff out. And I'm like, I am 100% a service provider at this point.
You're Michael Ovitz.
Yeah, I'm Michael Ovitz. I actually, I'm going around and like, you know.
That was so surreal when we got to do our episode with him. Like, it's like, and it's such a window into this world. And to your point, like the Andreessen guys and Andreessen Horowitz, they realized it before anybody. They helped shape this world, and like it's become Hollywood.
100%, 100%. So I want to flip to let's talk State of Venture in a minute, because I think that Andreessen stuff is all fascinating. I would love to. I had like one very clear worldview of how this was playing out, and now it's been a little, it's definitely changed. And so it's funny because we launched it in January or beginning of February, and like the market was pulling back at that exact time, right? And so everything that I was like super paranoid about, like, you know, hey, did returns really matter versus just access and the ability to win deals predicated not on valuation, but on, you know, service that you bring or gravitas or personality, all that stuff. As the podcast has risen, it's like they're actually just directly inversely correlated. Like as the podcast has had success, it's mattered less and less, I think. And so it's just like, it's kind of a funny, ironic thing. Now,
all right, I got my mainframes all set up. Let's do this.
I know. Well, my time has freed up, which is the other side of it that's actually been nice. Of not a ton of companies are fundraising right now, and so in a weird way.
Well, let's put it this way: not a lot of companies are fundraising right now at the terms that you would be excited about writing a check right now.
That's right. And also not a lot of people are just sitting on their hands saying like, hey, why do we need to go out and raise? And so it's an interesting thing, but those were kind of the insights that I had. And then you get lucky with some stuff, right? Like I knew I could be kind of a neutral voice that could be likable enough to like have people want to come on. I'm not interesting enough to like carry a show with like opinions and stuff. Like I knew I could be Lex Friedman. I couldn't be like Joe Rogan, you know, like I knew that I could do one of those things and not the other. And it just so happened that like I sort of fell into Zach Weinberg coming on board after we started with Nikita and Zach, and Nikita had his company thing going on, and Zach had some back to the compliance considerations that Battery had. General Catalyst has some of the similar ones, and they were gracious and amazing to work with about all this stuff. But it was kind of a godsend that Zach came on board, because you talk about someone that like just Weinberg just doesn't care what people think, and he's super bright, and he is willing to say what is on his mind. And I've never that's all a very traits that I don't have. I do care what people think. You know, I'll like, I am not post cancellation in the way that he is. And so he's been a kind of godsend for that. I don't know where all this stuff's going to go, but it's been fun, accidental, probably similar to you guys in terms of just like you just keep at it.
Well, I'm curious. You had we had in the outline some stuff talking about kind of podcast business model and stuff. I think it'd be fun to riff on that if you're up for it before we talk state of venture, because I think it's all related, right? Like,
well, so I would love to let's go back real fast just to tell the story, because I would love to hear the business side of it. So where were you guys? Were you both still at Madrona when you launched?
Yes.
Yeah, for the first maybe 6 months or so of the show.
Oh yeah, and then you started PSL, and I stayed at Madrona for another couple of years, I think. Yeah, probably 2 years.
Yeah.
And so as that's going on, what was the cadence of episodes? And like, how did you validate that it was actually working? It sounds like it started as acquired, right? And David, you mentioned you got 10 episodes out of the way in the beginning, and then you had to deviate the strategy. So maybe take through, like, you started in October and you started slogging ahead, and what happened?
The tagline was acquisitions that actually went well, and then we finished those. So we needed something else to do. Yeah. No, when you sent over the outline, which by the way, good job as interviewer, being extremely prepared and having very thoughtful ahead of time questions. I was trying to do the normal acquired thing that we do, which is like try to rather than making up what the story was in a way that is sort of the narrative fallacy that is a convenient story to tell, to try to like actually pull out some like both remember specific moments the way I felt in time, but then look up old emails and stuff. And David, I had forgotten about this. Our original, we made no promises to each other about schedule. It was whenever we're starting to feel like we should do another episode, we should do another episode. And then once that created...
And we didn't have sponsors, so there was no...
Right.
We had no commitments to anybody, except ourselves, to whom we made no commitments.
Because neither of us thought it would go anywhere. We'd be like, this is a fun side project, but like we're both very busy and very focused on, building stuff. And this was not the thing we were building. And so then I think once we realized like, okay, it would be better if there weren't these random multi-month breaks between episodes. I think the next tightest way that we constrained it was whenever we finish an episode, we will always schedule the next one. So we always at least know there's another one coming. And you and I were both really, really resistant to, at least I was, and I felt like maybe I projected this on you, but I might have dragged you along with me. I never wanted to set goals for the show because I thought that would make it less fun. And I exclusively wanted to do this as a way to have fun. And I thought like if it felt too much like a job, then I wouldn't want to do it. And so like there was never a growth goal. There was never a schedule that we were keeping until it took 2.5 years or something like that before we decided finally, okay, we'll do a sponsor.
How many episodes was that? 2.5 years?
50, 60-ish.
Something like that.
Yeah. And you were talking about like, did you doubt in the early days? Were there points in time that you thought like, hey, this is taking up too much time, or because you weren't beholden to either metrics or like a timeline of cadence that you were going after, that like, hey, but it's fun. It's not work.
I think the latter. You can check me on that, David, but I never felt, there was actually a few moments where like I was bored with 2 or 3 episodes in a row. So my heart wasn't in it, but I never was like, let's stop doing it.
Totally. I think if anything, it was the opposite in a way. I think as time went on and the show got bigger, I mean, we've basically, it's interesting, right? Like we're kind of on a classic exponential growth curve in that like we've doubled our audience base every year that we've done the show. And for for 7 years, for many years, that going from 1,500 to 3,000 doesn't feel like much is going on, right? But then going from 100,000 to 250,000, like, well, it starts to get meaningful.
Whoa. And let's not make up numbers. Last year we went from 50,000 to 100,000 when you're measuring by number of people who listen to each episode in the first 90 days. The total audience at this point who listens in any given month is about 250,000. But like, if you literally measure by like how many people listen to an average episode, that number has doubled every year for 7 years. Kind of no matter what we've tried to do or not do, there is something about like building a content brand where like we had we had a hell of a summer. The year that Uber, Lyft, Slack, Pinterest all went public at the same time, and that was like right as we had really honed the skill as like business storytellers who lived through all of those stories as participants and enthusiasts of all of those companies, where we were like, whoa, this just kind of landed in our lap right as we got good at this. So that year was better, but I think like on average, it's been a doubling every year.
Yes. But it's so for along the way, like, I can't remember exactly when. I could think about it, but at some point a few years ago in that journey, I was kind of like, there's something really interesting happening here. Like, there's a lot of potential in what we're doing. And it was because we were doing it, like we were the protagonists leading this, living this story. Most of the rest of the world didn't get it. Like, the rest of the venture industry didn't get it. Friends and family didn't get it.
You mean there's something interesting going on with like business creators?
Yeah.
Yeah.
There's something nice in that, by the way, of like, you know, for me, the flip side of having a bunch of Twitter followers when I started was it sort of launched loud, and then there was a very it's almost like a D2C consumer subscription thing or consumer subscription product where like the episode 1 churn was like so significant because one, like you can't be all things, you know, people liked my jokes, and so it's like you can't be all things to what it was basically it manifested itself as whatever people thought it would be from my Twitter or Nikita's Twitter or Zach's Twitters. And then it couldn't be that to all people. And so you see the like fall off in episode 1 and you're like, oh shit. And my brother actually works in podcasts, and he is at The Athletic, and he had told me when like they launch podcasts with people that have existing followings on different platforms, he was like, just be prepared. The first like 4 to 6 weeks, you're going to keep going down and it's going to feel like the world's ending, right? And I think without that insight, I would have just given up, right? And so to some extent, when people ask me about this now, I'm like, if you have a big platform, Ben Thompson said, I think he did 30 episodes with Gruber before they launched their thing together.
That's the most extreme example ever.
That's extreme. Nikita, Zach, and I did like 4, and I think I would have done 9. You know, or something like, and
we did 1. It's never released, and it's awful. But
the thing is, you guys launched with how many people listening, right? And so you got to get better.
Yeah, dude, it was a different era. Yeah,
you got to get better over time, and so like every time someone discovered you, the quality of the product was like significantly better. Versus if you had launched with, your following today, like, and you weren't as good as you are now. Then, a lot of people would be like, well, this isn't great.
Yeah, totally.
Like, and so there was something that in retrospect, just slogging ahead, I really had to know this was going to happen versus it's kind of nice when I tell people, I'm like, just start throwing it out there. If you don't have a following, just start doing it, right? If you have a following, then like be very prepared because people come once.
Good luck.
And then you really have to win them back, right? And then that was sort of what happened for me. So, yeah.
Have you ever heard the Ira Glass thing about taste?
Yes.
There's these 4 YouTube videos. They're each like 10 minutes long. I think it's like cut out of an old 90s documentary. It's an interview with him. And one of them is where he's talking about how difficult it is to be a person with a high level of taste, but a low level of skill. Because when you're first starting out, you might have taste and you know what good looks like. And then you go and you make the thing because you're passionate about making the thing because like you have good taste and you like making things in the world and you make it and it sucks. And you're like, wow, this is awful because I know what good is and this is so far from it. And most of being a creative person in honing a craft is starting with taste and just trying to shrink that gap between what you know it could be and what it actually is.
That's fascinating. Yeah, it's one of those, it is interesting when I felt like I'd figured out Twitter as a form factor and a little bit, like at least to the extent I was doing it and like, I know what would work and what wouldn't. And like, and then you go and like the amount of surface area you're opening yourself up to with Twitter is like literally 140 to 280 characters, right? And people can only critique you so much and can only know you so well. And then you move to like a different form factor and you have to learn all these different taste and quality things. And like I knew we weren't good or as good as I wanted to be. And every episode, I just kept being like, as long as it's better than the last episode, right? And that was kind of all we were executing on. And so
that's what you do.
To get super specific on what, so we mentioned like we're having fun, and especially when we weren't monetizing it. And for the longest time, we didn't monetize it at any significant level. So call it the first 5 years before it was like a real business, even 5.5 years. We had these 3 priorities, and we would get together every 6 months, David, and have like the little acquired summit, which was dinner. And we would review like, are these still our 3 priorities? And number 1 was learning. And it was always like in this order. Number 2 was our network, like get to know guests so that we have real relationship with those guests and use the podcast as a vehicle to expand that. So that's how we got to know Nolan Bushnell and Trip Hawkins, the founder of EA, and for people we already had relationships with, like Tom Alberg, who started Madrona and was the original angel investor in Amazon and was on the board until just a few years ago. It was an opportunity to like get to know Tom better because we got to spend an hour dedicated just sitting talking to him. And then third was reputation, like influence. It was the sort of listener facing side of things. And then we would always specifically assert a non-goal is monetization, because we were very confident that doing this would provide enough goodness that like that will happen at some point. And it never occurred to us that monetizing the show could make the show better. And I think we were pretty foolish in that for a long time, David, because we were so staunchly like anti-advertiser. It's because most podcast ads suck. And like when we first dipped our toe in and said, okay, SVB, will you take a chance on us and be our first sponsor? We were like, what if we do it differently, where every single episode we're actually interviewing one of the bankers who covers a sector at SVB to talk about like what's going on that's interesting in that sector and related to the episode very often. And our whole sort of format over the last few years has really followed that. Like with Vanta now, interviewing them on like, what Christina, what is the actual interesting insights for people who aren't in the compliance world to pull out of why your strategy is very compelling. And so I think like we did not realize that there was material room for innovation on making sponsorship into content by being extremely selective about our sponsors and the format that we did with them. And on top of that, I don't think we realized how much better the show could get by reinvesting capital into it. I mean, if you think about how our editor turns stuff that we do into pure magic, it has made the show so much better.
Well, to me, it's like that's only just a small part of it. Like I feel this is why I wanted to chat with you about what you're thinking and the whole business model and investing and podcasting and sponsorship. Like I think we're just scratching the surface of how powerful this can be, even at Acquired. I think we're doing a lot of really innovative stuff, but like I just see how powerful it is, and I think it can be more. Like Vanta, great example. Like they're our presenting sponsor for this past season. We invested in the company. We went to their all hands. We recorded the all hands. We released the all hands in our LP show in our second feed. Like we can just like go so far into the depth of partnership with these companies. And it's like, great. It's an amazing company. Vanta is an incredible company. They raised probably the best round of this year, and they deserve it.
Yeah, Christina's they're amazing. I mean, their execution's been just incredible to see. And when you say, by the way, when you say you invested in it, so Ben, you have Pioneer Square Labs, right?
Yep.
David, so when you say invested, do you invest personally, David, and Ben, you invest out of Pioneer Square Labs, or how does that work?
Good question. So for me, it's a little bit more complicated. I'm a GP at Pioneer Square Labs and our venture fund PSL Ventures, which invests classic seed investing. So like multi-million-dollar lead checks, board seats, Pacific Northwest companies. Like call us old-fashioned, but it's the thing that we really like to do, and it's the way that we feel we can like most work directly with founders. And we only write a few big checks a year, and it's classic venture. That doesn't fit at all with Vanta's raising a round that's it's a Series B, but $1.5 billion valuation.
Technically a B, but yeah.
Yeah. And so that one was a personal check, because I just, there's zero way to make that fit into the fund strategy. But for David, that is your fund strategy.
Yeah, well, that's what I was saying. And when I started to realize a few years ago, I was like, wow, I know a secret that this is way more powerful than anybody in this whole industry realizes. So yeah, I have a fund on AngelList that I run with my friend, Nat Manning. It's a $15 million fund. And we invest out of that. And 100% of our LPs are listeners of the show. 100% of the founders that we invest in are listeners of the show. There's a high degree of overlap between people who have been on the show or protagonists that we've covered on the show and, that are in both of those categories. There's a high degree of overlap between people who we invest in and who are also LPs of the show. And that's what I just realized is like, I could sit at a venture firm being a GP in the traditional sense, or I could see how deep the rabbit hole goes on like what's possible in this new Hollywood style world, like you said.
Yeah, it's fascinating. So for me, you had asked about what we were thinking, or I'm thinking about this, and I don't really know to what end I'm doing this, other than I'm enjoying it. It feels like there's an opportunity here, getting positive feedback around a lot of the stuff. And I both have the time in terms of like the market's slower, and the willingness from my partners to invest in this. And so like the budget, while your guys' quality is just like amazing in what you guys do from a video and audio standpoint, the amount that we invest isn't a small amount in making this, successful and making this work.
By the way, your time being the biggest part of the budget.
By far the biggest time of the budget, right? And then the other thing is we've been resistant in taking on advertising, just because I sort of took that inspiration from All In, that they didn't really have it, and I don't know. It felt like we're not doing this for money, explicit dollars that are coming from this. And so why, if we're not trading off any investments that we would or wouldn't make, and we don't need to do it, then why do it? But I don't know. Like at some point that could change. And I mean, we certainly could up the level of production to what you guys have from a video and audio standpoint. The other thing that we have, at least right now, is there is some level of like topicalness. Like yours are definitive guides and mine are like, could be outdated in hours, right? And so to some extent,
well, I feel like you're actually somewhere in the middle, right? Like Jake Allen Twist is like, could be outdated in hours, and that's explicitly what it is.
I've moved more to the middle. Originally, when we started, it was more on one end of it. And so I'm definitely more in the middle, that like some of these things will live on, certainly. And so in those ones, like if you go look at the Parker Conrad interview, like we had very real video crew in place that we hired to go do that. Same thing with Aaron Levy, went and hired a video crew to go do that.
Probably should have done that with Brad Gerstner, but instead David and I spent 2 hours figuring out how to set up a bunch of tripods in their office.
Yeah, well, I have a guy if you're interested in, if you guys need to do these things on the road, we have a good team that can help on that. But yeah, it's interesting. And so I don't know, I agree with you. It's funny, when I launched, we got a bunch of pushback from random people being like, "Oh, we don't need another podcast." And I'm like, you know what? That's great. You don't have to listen.
Yeah, exactly.
Actually, we're not stealing a time slot from someone else, right? It's not like there's a limited shelf space on what can exist. And to some extent, I'm excited as these tools. I don't think we're at the end state that like the tools are totally seamless at all. Like I think we're, I don't know, in the second half, or maybe the beginning of the second half, or whatever, the beginning of the third quarter, whatever the right sports analogy is, in terms of like the tooling being as easy as it can be to get going. But it's definitely getting better. And so I'm glad that all exists and people can experiment with different business models, like what you guys are doing, what Packy's doing, what Ben Thompson's doing.
It's all different. I think that's what's so cool, is all of these shows are all different.
And it's all, for the most part, free to the listener, right? And so it's like, of course, who cares? Like this content you have infinite access to all these people's time and energy. And so I just think that's awesome that there's so many people out there trying. And I honestly wish that there were more doing different flavors of what you're doing, or different flavors of what I'm doing, or different flavors of what Packy's doing. Like it feels like we haven't even scratched the surface of the business model opportunities, the types of content.
Well, and that's one thing, I wanted to bring up, and I think that we've found that you might find it. I'd encourage you to experiment with sponsorship, quote unquote. We used to think about it just like you're thinking about it, which is on the cost side. Like, oh, does it look weird if like we can afford the cost to produce the show? Like, does it look weird if we're getting sponsors to cover the cost? It's not actually about the cost side. It's about what you can do. Like, we have so much of a deeper relationship with Vanto, with Modern Treasury, with PitchBook.
PitchBook sponsored the show. We got much more familiar with the PitchBook product. We use the PitchBook product a lot more for pulling out stuff on the show. And then we got to work with PitchBook out of an unbelievably random thing that they had access to, where they offered us the ability to use the brand new basketball hockey arena in Seattle for a night for a live show. And like, we have fans at PitchBook, but that wouldn't have happened like organically without us having the deep relationship with their marketing team.
Yeah, it's a reason to go do that. Like, we are going to do a whole bunch of episodes together, and we're going to like figure out how to make that awesome for you. And then you get to build these relationships.
Yeah. It's interesting. I feel like we're still experimenting on the model side of all this stuff, like what the end product ends up being. And so it's almost like I want to control the variables as we're sort of,
You're still early.
Sometimes Weinberg's on, sometimes he's not. Sometimes it's just me. I asked if you guys wanted to do this live because I actually like doing these things live, but that also limits my access to who can be on versus not.
Wait till you need them to be in somewhere geographically, like an actual person in a seat. It's insane how much that, for our live show, I kept thinking, oh my gosh, it's a no-brainer for this person. And like, 20 people that we wanted, David, couldn't make it and be in Seattle on that date, including big executives in Seattle who were like, yes, I want to do this.
It is a crazy constraint, right? And so what is the trade-off of a willingness to schedule in person? That said, I'm not totally convinced Parker Conrad tells me the story of Zenefits if he knows there's a like camera staring in his face. So I don't know.
Oh, in person is by far the best. Always the best.
But it's like at what expense of trading all this stuff off?
Yep.
So maybe before we transition to the state of venture and what you guys are seeing, are there interesting moments or anecdotes along the way? I know like you had mentioned that the Taylor Swift episode was like a big breakthrough, but were there some that obviously happened in the last 12 months. And so along the way, were there just like surreal moments, either from a growth standpoint or a willingness for this person to come on standpoint that you guys were like, I can't believe we've gotten here?
Logan, it's like totally counter to the advice of act like you've been here, for us to reveal the times where we were like pinching ourselves. How is this actually happening? But it happens like all of the time. Yeah. We try to be like pretty chill about like, we're sitting here with Doug Leone at Sequoia's office for him to tell the definitive story of when he came into Sequoia through today. Meanwhile, we're both like, oh my God. And like that happens several times a year. I mean, the arena show is definitely one of those. When we met up with Nolan Bushnell, David, I'd say that was a huge one for me.
Yeah, that was so cool. Oh, man.
I had my 5th birthday party at Chuck E. Cheese. For everyone who doesn't know, like Nolan both started Atari and Chuck E. Cheese and is a absolute cowboy.
And Atari birthed everything.
Totally.
I mean, Steve Jobs worked for Nolan. Atari was Sequoia Capital's first investment in 1972. Like, it's crazy.
Yeah. Or like the emails we get from, I don't think I can name this name, but CEOs of very large companies that we have covered who say, this is by far the best telling of my company's story ever. How did you guys find this? And, we respond back like, hey, it's all public information. You just have to like look and look and look and look and look. That's really cool.
That's the craziest stuff these days, is just like,
or like, oh, now it's, and this also recently happened. It is now mandatory if you join my company to listen to the Acquired episode on the company to become familiar with it. Like, that's crazy, because I'm like, these are all publicly available resources that just haven't been pulled and assembled and ruthlessly whittled. Like, that's the other thing that like goes into this is, David, you combing over the outline 4, 5, 6 times, and then in post, me listening to every single sentence, highlighting into script, working with our editor on like, can it be a clean cut if we still delete this one because I don't feel this sentence carried the gravitas, and if it's going to be 3 hours, it has to be like the most interesting shit all the time for 3 hours. Yeah,
keeping it at that length, but also keeping people intrigued is a tough exercise. But it's interesting. Maybe take through the process now of like what it actually is for you guys to produce an episode, just because you referenced it.
Do you want a case study, David?
Yeah, well, it's live and in process. We're starting next season.
Well, do you want to, maybe because we don't know when this is going to come out, do you want a case study NVIDIA?
Sure. Yeah. Like NVIDIA is a pretty good modern example of an acquired story.
And interesting specifically because there's not a book. Sometimes it's not that it's like, oh, it's easy, we read the book and then we're done, because there's another 50 sources that go into it. But like, that is always a situation where we know where to start. And right now our next upcoming episode has an autobiography, so there's a place to start and we can spider off from there, and that can give us ideas of other places to look. But NVIDIA was fascinating because there just isn't. There is not a definitive telling of that company anywhere. And so you do what every other person would do, is you start on the Wikipedia page and you start sort of using that to inform your list of, here's a bunch of stuff that I should research based on like, oh, I forgot they got into that product line. Let me go look into the history of that product line and all of its competitors. But it lands you in weird places. Like, you find yourself watching obscure talks on YouTube with only a couple hundred views because it was by some mid-level executive at like an industry-only conference.
YouTube is the best. YouTube is like the greatest gift to humanity.
And like, no one cared enough to watch it, but actually there's a sort of like first-party account of something that is mischaracterized in the media about that business that's important to know. Or like, we use Tegas all the time to go and like find another sponsor of the show that turned out to build a really valuable product for us. But like, to get interviews with former employees of the company, that's a really interesting place. And so our two research processes look different. Mine look like this really random text edit document of like, I clean it up as we get closer to the show, but it's just like a whole bunch of sort of half thoughts of, I think this is an interesting point to make about this company, but I don't know where I'm going to make them in the story. And then David is a really cold version of like an actual timeline of events that we have sort of assembled, and we don't share them with each other beforehand, importantly, so we can have real live insights on the show and surprise each other, where he can sort of pull out events that I didn't know happened in history, and I can sort of make connections and bring up mental models that he otherwise wouldn't have thought of in the research.
It's fascinating. So how much time do you each put into like an average episode? How long does that take you to prep?
I think it's about 100 person hours of prep work.
Each or total?
Total.
Wow.
Yeah. I usually spend 2 weeks on it.
So maybe it's more than...
The sort of organic division of labor that I think we arrived to over time is, Ben owns the analysis that used to be in its like dedicated sections in the episodes, but now is kind of peppered throughout the show, as Ben, you were saying. And I own the storytelling. So for me, yeah, it's, I really write, it's somewhere between an outline and a script, but it's much closer to a script these days. That's, 15, 20, 30, 40 pages long on like, this is the story of this company.
And how long will you guys record for? Do you keep, is it end up being about half of what we hear is what's recorded?
It's about three quarters.
3/4, got it.
Yeah.
Wow.
We tend to turn 4 hours into 3.
Yeah, that's incredible. I mean, you could tell just how much work goes into all this stuff, given the output of it. But you're really doing a public service.
The most likely thing that we cut, by the way, is usually a false start. Like, we really do, we put so much into you can get yourself mentally messed up in putting so much gravitas on like producing something so polished that like we've had several episodes where we get 20 minutes in and we're both looking at each other. We're like, let's take 10, go get a coffee, and let's come back and just start this thing over because we like walked out on stage wrong and it's felt wrong ever since. And it's that didn't used to happen when it was a lower key hobby. And now that we're like, we sure hope this becomes the definitive take on this company that the CEO recognizes and, you know, shares with the board of directors. Like that is, it instills a lot more gravitas on us before going into it.
It was interesting. I've sort of stopped doing this now, but when in the early days of doing it with Nikita and Zach, we would generally start with a topic, hate our chemistry and flow, go to the next topic, go to the next topic, and then go back to the first topic. You know, we're like, all right, we're going to eliminate that. We're going to go back through it, right?
Part of it's just about like warming up too.
Yeah, it's kind of just a flow state of, I remember we tried everything. One time we all went and got beers and like drank half a beer as if like that might help. I don't think it did. I think it actually hurt the quality of it, but we were like, we just gotta, we're too uptight right now. Thanks for, going through all that stuff. Any last thoughts? I mean, we've covered a bunch of ground here about the history of Acquired, about you guys working together, about business models, about, I guess, my own podcast. Any last thoughts or anything that you guys would want to share or that we didn't touch on?
There's a thing I've been sort of noodling on recently, trying to decide if it's unique to content or if it applies to all founders or all creators of a thing in the world. And in particular, I think it is interesting to think in extremes. So think about whatever equation makes your thing work and make one variable infinity and what happens to the rest of it. And so one easy one is, what if there was infinite time? Like, what if Acquired existed forever? What would sort of naturally happen? And I keep thinking about this like doubling, that it's doubled every year since inception. At some point, we will hit the top of the S curve because we will saturate the market, or we will need to change the content in order to appeal to a larger market, which neither of us have any incentive to do because I think that we have exactly the audience that we wanted. And if you produce regular and high quality content in an opinionated way, ad infinitum, you will accrue all of the people for whom there is content market fit with that thing. And you can accelerate that through various ways, but it might cost you because if you accelerate, you will also accidentally increase the blast radius of who you are acquiring. And so by going slow and only going from 1,500 to 3,000 from year 1 to year 2, like we didn't have to try to appeal to people that wouldn't have found the show naturally. So we were able to keep the sort of like strike zone of who became a listener super organic. And I think this is a lesson that can be taken for more people in venture because in general, what it means is you're taking a lower IRR for a more valuable company later. And it's like, you could think about it like you can increase your competitive advantage, or you can improve your pricing power in the out years, or you can just improve your customer love, and keeping that high the entire time is important. But there's something to like, if you're willing to take longer, you can just, and you're willing to assume that the right people will find you, you can save yourself a lot of trouble and a lot of, like, frankly, in the content business, trolls, by not accidentally increasing the blast radius of who you want and therefore attracting the wrong people.
Yeah, it's super interesting. I mean, I think it is more broadly applicable. If you think about the companies that were either bootstrapped or lightly capitalized over the years, and I mean, it could be everything. It could be everything from Epic and Esri that like have never really taken money, or it could be companies like Atlassian or Viva or...
Oh, Viva, such a great story.
There is something associated with like when you're not forced, when you're focused on instead what the natural absorption rate of a market is, and you're not chasing everything, like all the infinite opportunities that could exist for what, venture capitalists might encourage you to go do, as the case may be, and instead are just gliding along the glide path of what is natural. I think oftentimes it leads to making these organic, thoughtful decisions that are on a timeline conducive to what the market is receptive to, rather than what, a VC thinks that their appropriate IRR or opportunity should be. And it's one of these tropes in VC in general that discourages founders from taking VC. It's like, oh, you don't want our money.
Yeah.
It's kind of a trope, but like, I do genuinely believe it in a lot of cases. I don't know what percentage of like companies that have raised venture capital should have just taken out debt and had some different ambition of what they were going for. But it's some decent number. And I hope that the last couple years of VC and capital being as abundant as it is didn't lead to everyone or 90% of people raising VC, because there's really some special companies that have been built around constraints and dogmatic focus on like what they're pursuing. And so I think it's more broadly applicable than just this.
Totally agree. And it's totally informed my perspective as a board member. Like when we invest in these companies, and I'm on a few boards right now from PSL Ventures, where there is very clear opportunity in front of us for reinvestment. And so we should be good capital allocators and go. And there are other ones for which that doesn't make sense. And we need to figure out what the natural absorption rate of the market is. And once we feel like, oh my God, there is a very clear opportunity to not accidentally to use my former example, like make a huge blast radius when actually we want a very concentrated laser shot of the types of people we're acquiring and why and what we know about them as customers. You should have to be really careful of, Logan, to your point, the broad capital availability, not letting that guide your company to do inorganic things.
Yeah, no, it's a really interesting point that I think has broad applicability. Well, so that's actually an interesting. I mean, we talked on capital allocation and all that. When I was going back and listening to a podcast you guys did earlier this year, it was kind of on the state of venture capital, and I think you two are both students of the venture capital history now, having produced a number of primers on how these firms came to be. And I actually, I had done a lot of that myself, kind of going back through. I think it's, what is it, the Cal library or whatever that has Don Gallant. Like I remember going back and reading those transcripts whenever.
Such a gem.
It's really amazing. And so I think that I think it would be interesting to kind of talk through how you view the industry as it's evolved to where it is today. And so your perspective on where we are right now, we're recording this, summer of 2022. Where do you think the industry is from a maturation standpoint, from a product offering standpoint, from a where we're headed from here standpoint, as people that have been sort of students of the history of the industry?
Ooh. Just a big, small question, not a lot of consequence to that. Oh, it's great. One of the, I'm sure Ben also will have a few thoughts. I have plenty, but I thought one of the best summing up of the current state that I've heard recently was from Brad Gerstner on our episode with him, where he was like, he put it very simply that I agree with this. He said, the venture capital industry has industrialized over the past decade and a half, 2 decades. And the same thing happened in private equity in the previous generation. And the same thing happened in the public markets. Oh my God, we did our history on Berkshire Hathaway and like the Ben Graham days and like when Warren was starting, it was public market investing was non-industrialized. Let's just put it that way. And there were $100 bills to be had sitting on the ground. And all that gets arbitraged away as competition comes in. And like, that's happening in venture. And I don't think that's necessarily a bad thing. I think it's probably a good thing. Like more capital for more companies, more founders. I also think, to what we were just talking about there, I think will end up being a feature of the venture capital industry that a lot of people think is a bug right now, is the decoupling of capital and advice and governance. bad things can happen in a lack of governance, but bad things can happen and have happened many times in history with governance from VCs. And nobody knows better than founders, like what the right things are to do. So you were just talking about, investing capital, soaking capital into markets. And, I know in my history as a board member, when I used to be a board member, I used to give terrible advice, not all the time, but sometimes. And, and I think founders now have the option to raise capital in ways that don't necessarily come bundled with that.
I think one of the things that I felt was clearly happening over the course of the last 2 years, especially, and even a couple of years prior to that, I was noodling on it. Was I think I forget who said this between the two of you, but kind of talking about getting stuck in the middle of, there was kind of the shoe leather side of what Benchmark does, and then the Walmart effect of like what Tiger does on the other side from a scale standpoint. And if you get caught in the middle, it's you could be JC Penney and be neither, so boutique and so specialized, or so big and powerful. And I really felt like that was definitely happening over the course of the last couple years. And it felt like that was part of the inspiration for doing this at all. It just felt like, if you're not known for something, you're known for nothing. And the controversial analogy I'll use at times is like, it's better to be Donald Trump than it is to be Jeb Bush. And so it's better to deeply appeal very narrowly than broadly appeal, but thinly. And I think that's true of, content like TikTok, yep. Right? I think it's hyper-personalized.
Anything that the internet happens to will have that characteristic.
Anything the internet happens to, right? Ultimately, you need to stand for something or you're thought of for nothing. And I was really, when prices were somewhat fixed as determined by the entrepreneur, that was 100% happening, where it was a Chinese menu of service offerings from VCs. And an entrepreneur said, hey, at $400 million, this is the price. And some VCs disqualified themselves from the price. But then, they got to say, hey, I want the boutiqueness of X firm, or the scale of Y firm, or the gravitas of Z firm, or whatever it was, right? And now as the market's pulled back, that was very much a product of capital being infinitely accessible to venture managers, and therefore also to entrepreneurs, right? And as capital's pulled back, and it's a bit more about the picking and the valuation that people are thinking through, I wonder to what extent that continues to hold. When we draw the analogies of private equity, right, institutional or industrializing, to use Brad Gerstner's term, or Berkshire Hathaway, like Berkshire Hathaway theoretically has the equal access to as most retail investors or whatever, right? Like, I'm sure it's different, but for the most part, they're operating on a level playing field from an information standpoint. Private equity, for the most part, has like the function of price. It's been a fairly scalable asset class. And for the most part, what you're willing to sell something for, you'll take a higher price from someone. If you're walking away from the asset, almost like selling your house, you're willing to take a higher price. And so while the asset heft that comes with having big funds mattered, like at the end of the day, the brands of these firms in the private equity industry only matter so much. And as an asset class, it has a fairly linear distribution, right, of how the different, firms play out. Versus venture has always been this kind of bar, or the staircase of venture returns, and there's so much that compounds to the top. And also there's so many, there's only so much scalability of the capital at all. And so I guess one of the things that I'm starting to wonder, and it's always sort of been in the back of my mind, is like, how much does the Tiger or SoftBank approach to all of this? How much does that actually work, right, in the world of declining prices? And so I don't know if you guys have thoughts on any of that, but it's been a wrench that I've sort of seen in the last couple of months, especially.
It's interesting. I used to, 6 months ago, I definitely believed that venture capital was just becoming capital. And like, there would be, there's this incredible post called When Tailwinds Vanish by John Luddig at Founders Fund. He's got a Substack, and it talks about this notion of Sandhill Sachs, that basically there's going to be a West Coast, Goldman Sachs. And who's going to be that? Is it Andreessen? Is it Founder? Who knows? But it's one of these really big platforms that sort of has the opportunity to become the like financial institution for startup equity and things that used to be startups, so technology equities.
By the way, and not just to plug our friends at Founders Fund, but then also Everett Randall wrote Playing a Different Game, the Tiger one, right? Which I was like, everyone heralded, both of them wrote amazing pieces. But Ben, maybe talk about Luddig's thing.
The pullback is interesting because I think that thesis, the industrialization of venture capital becoming capital, it is true for high-performing, obvious companies. And that will continue to be the case. I don't know what percentile it's at. If it's the 50% or below company, the bottom quartile of companies, maybe it's everyone but the top decile, the most obvious decile. I think this market correction will probably bring a return to shoe leather. And for those, anyone at that sort of marginal company or lower, for which there is more risk and less, there's going to be less sort of a bidding process for that company. That company might only have one term sheet. It may have some adverse terms in it that they may not get to pick who the financer is or what the valuation is. And so that's where there's sort of opportunity for early stage tech investors, or, this is not a common asset class, but like distressed company who just need $5 million to sort of turn that corner, and then they can look attractive type tech companies that are like mid stage. I do think there will be an increasing opportunity for what we used to think of 10, 20 years ago as venture capital. Well, not 20 years ago, because that was the dot-com bubble, but 10 and 30 years ago. For the non-obvious companies, but we've already blown the doors wide open on massive amounts of late-stage private capital and very clearly paved roads to public equities for the obvious companies. And I don't think there's any return. There's no coming back from that. It's just about the marginal company.
Yeah, it's interesting. I'm seeing more and more there's wider spreads in terms of what people are willing to pay. And there's no consistency, I would say, in terms of like the fundraise process. Entrepreneurs go out and one firm will tell you 200, one firm will tell you 700, and one firm will say, we're not investing. And, it's kind of like what's weird right now is there's no consensus around what anything is going to be worth because the public markets has been turned upside down so much. And so access used to be the constraint, right? Because the only way to get the opportunity to invest in these A-plus companies was to have the access to them, right? And increasingly, I'm kind of seeing price come back into the consideration because for a little while, like the governor on price was like 409A and not wanting that to get too high for the employees, or maybe some investors cared about or some CEOs cared about hey, I want to be able to execute on this for my investor that's coming in, right? Or maybe they said, hey, I can get Sequoia at this price and SoftBank at that price, and that trade-off is worth it to take Sequoia. Maybe it's that. But for the most part, price was kind of a constant to whatever that at a later stage of investing. And now there's this dispersion in price that I think is democratizing access. And these businesses that raised at these crazy prices last year from A-plus firms could maybe raise at the same price this year, but it's not from that A-plus firm, right? And so it's actually interestingly opening up. If someone's willing to pay a super high price, there still is this opportunity for access that didn't exist last year, right? And I don't know exactly what happens to that, but it's interesting. And it's at a certain valuation level. And I think it's a weird moment in time right now that this is true. And eventually we'll all go back to agreeing what prices are worth. And then when that happens, it'll probably turn back into the beauty contest that it was. But it's a weird moment right now in the market.
it's temporarily really bad for founders, because when you have really wide spreads, people all look at each other and go, then no one knows what it's worth if there's no consistency in the offers that are coming in. And so therefore, I don't want to accidentally pay the wrong price, because here I am, I'm in the investment business. What I should do is, buy underpriced assets relative to what the market, either should pay for them today based on their future cash flows, or I have some, unique belief that this thing is more valuable today than other people are valuing it at, whatever. But if it's this massive spread, you're like, well, I'm not going to pay massively above what the correct price is for this asset. And so people stop. And like what we've talked about and referenced earlier on this show, when growth stage investors are saying, I kind of need to see like what market clearing multiples are right now before I make investments. Like, companies can't just like wait for 6 to 12 months for things to settle out. And so, I mean, unfortunately for a lot of founders, that creates like very attractive opportunities for investors with high conviction when no one else is willing to write a check to come in and at least write a check.
It's a super interesting point, and it's not really in my interest to say this, but I have, and so I'll say it again here, is like I've kind of encouraged entrepreneurs to just wait till after Labor Day to fundraise, and not because I think you could probably get a better price today than you could after Labor Day. I think there's probably the macro environment, it seems like it's deteriorating. And, there still are some firms that are operating, maybe not at December 2021 prices, but maybe March 2021 or something, right? And so you could probably go get a decent, better round done. But finding that requires turning over a lot of stones, and you're going to get jerked around in a bunch of different directions. And ultimately, raising at that higher price might not be beneficial in the long term for what it means for your employees and what it means, for an IPO or future ratchets or whatever it is. Like, it might not be the best thing for you. And so I've kind of been like, if you have to go raise, go get money, right? If you don't have to, like, hang out another 2.5 months or whatever it is, right? And just get to the other side of at least VCs collectively agreeing on what stuff's worth, because we're not there right now, and it leads to this super funky dynamic.
Yep.
Yeah, I think you guys are right that price is the big question right now. I don't see, and maybe that will lead to, it will lead to some changing dynamics and changing players and new ways of doing venture that emerge because it's a complex adaptive system. But I don't think all the change that's happened in the last 5 to 10 years is going away.
Totally agree.
Like, we're not going back to, I joined the industry in 2010 and like, my God, it was so, we're not going back to those eras where like, price is one thing, but like just the way that VCs existed, the nature of how startups and founders and VCs interacted, like, I really don't think we're going back to that era.
The power dynamic has definitely shifted. The last year, it was, 10 years ago when you started, it was 100% on the VC side. And I just remember it was like, people went and fundraised, and it was 6 weeks until you actually would plan to get a term sheet or something. And then it became 6 hours or unsolicited term sheets coming in your inbox. And now I think we're going back away from that a little bit, and like people are going to have the ability to do diligence. But I agree. The power dynamic should have always been in this direction, right? And it was almost a bug rather than a feature that it was the way it was, because capital was finite. But now I agree.
Well, and that's what I take the industrialization of venture to mean to me. It's like price always goes up and down, right? But like, it's that you can now have a much better experience as a founder and a company and choose features of what you want, and it would, oh my gosh, you used to plan for 3 to 6 months for a fundraise if you were on a board of a company. And like, that's just terrible for everybody.
Yeah. Well, any parting thoughts on the state of venture right now? It's obviously upside down. I imagine it doesn't impact Ben, like the early stage stuff you're doing. I assume it's business as usual as well, but
prices are different, but velocity is still high. Like, I'm not afraid to write checks right now because I know as long as I don't do anything stupid, there is a Series A investor that will be willing to invest at a higher price if things are going well for the company. I don't know what that means if things have dropped 50% in price or 100, that can't drop 100%, but I think things have probably dropped 33% to 50%. Like you used to see the very experienced second time founder being able to go and raise at a $30 or $40 million valuation if they were doing a price round out of the chute. That seems to have gone away. And we're sort of back to a return to the, $10-ish million valuation first round days of 2017, 18, whenever that was. So it's been interesting watching prices change, but the cool thing about investing at formation, which is really like what we do, and then take a very active role and be on the board and all that, is like our jobs are still the same and the pace at which we're deploying capital is still pretty much the same.
You won't be wrong based on valuation, right?
I'll just be wrong in all the other ways that I'm always wrong.
Yeah. Your insight will be wrong, not the price you pay. For me, we, there was an old adage that I think was very, ultimately led to sloppy thinking, but like you're never wrong on price. And it was like true if you're investing for like these companies to be billion, $5 billion, $10 billion companies, if you paid 10 posts or 20 posts or 30 posts or 50 posts, it shouldn't really matter. But then people started extrapolating the early stage mindset of that being true to growth stage, because all these companies were now worth like 10-20 billion dollars. And now as that's corrected back down, then price really does matter when multiples compress. So,
and the thing that we're seeing in early stage again is like, for a while I was not seeing the 6 cap note round. Like that had totally gone away. This idea of like, I'm going to raise, $300K to $1 million on a 6 cap note and we'll make some progress. And then we'll go raise a good old institutional venture round for the seed. And that just went away because there was so much seed capital wanting to play at formation. And I'm actually now starting to see those rounds happening again.
Well, good. Well, thank you both for doing this. This has been fun and sprawling and interesting to be able to cut it up and talk about all this stuff. We'll have to, as this format evolves and I figure out what I'm actually doing here, we'll have to have you guys back on. But this has been fun.
Oh, dude, you are off to such a good start. You're not only because you had the advantage of your Twitter following coming in, but like you're clearly putting the work into this, and that's ultimately what makes a good show, is putting the work in over time, and you're doing great.
Thank you. I appreciate it.
Thanks, Logan.
So that'll do it for episode 23 of Cartoon Avatars. Thank you to Zach Weinberg, per usual, for coming on, as well as Ben and David. We have a really exciting episode next week that you're going to hear. We're going to go back to a little bit of the crypto hits as we kind of wind down that series. And so there's a few people that I'm really excited to have join as we kind of bring that whole conversation to a close. So thanks everyone for joining, and look forward to seeing everyone next week.